And so that will be shared at a later date. So if you miss something, if you want to come back to something, that recording will be shared with all of you. So with that, Frayne, I will have you share your presentation. So bear with us.
Very good. Can you see that all right?
Yes, we do.
Perfect. Well, I will jump right in if that's okay, Jenna. All right. So good morning, everybody. Welcome to the seminar. The whole purpose of the seminar is provide you with some background information to be able to not only make hopefully some better marketing decisions, but more important to really understand how do you perform the analysis, right? There's a flood of information that's available in the marketplace today, especially for the major crops like corn, soybeans, and wheat. But to be able to filter out what's really important, what is just what I call the buzz of the day, gets to be a little bit of a challenge. So let's make sure that we're focusing in on those really, really key things. So this first session is going to be an introduction to fundamental analysis, which is really just a fancy way of saying we're really going to focus on the supply and demand conditions. So here's my contact information. Again, if you have any questions on follow-up, if you want to talk about things later on, I'd be happy to discuss that. You can either contact me directly or, again, you can go through the North Dakota Soybean Council and be able to reach me that way as well. So let's just dive right in, make sure my technology is working. There we go. I don't have a lot of time today. We're going to really kind of hit the high points, those core things you really need to know to try and be a better marketer and understand really what's going on and how the marketplace works. There's a set of mechanical things. There's a set of steps, if you will, check the box steps to putting together a marketing plan. And one of the things I always, get a lot of heat for, especially from some of the ag lenders in the state, is, boy, you got to do a better job of teaching farmers how to prepare a marketing plan and how to implement that. And I agree. I mean, there's a lot of misunderstanding about what this is. The marketing plan is really just a stepwise process that you can use to try and formalize, take your thoughts and rather than kind of winging it and moving your way through time, just kind of, well, we'll see how this goes. Actually having a plan in place, having some pricing objectives, some timing objectives, choosing the right marketing tool to be able to implement that plan. Now, again, today we don't have, during this session, I don't have time to go through all of these steps, but the challenge is really that first step. One farmer put it this way, he said, look, if you can just tell me what's going to happen in the marketplace, I'll do the rest of it, right? The rest of it I can figure out. Just let me know when is the high of the market going to hit, and I'll do the rest from there. It's like, well, I wish I was that smart. The things that are impacting the markets today are literally global. There's obviously things happening local. There's things happening within the domestic market. There's obviously things happening internationally. And every day that flow of information changes a little bit. So in this marketing plan process, setting this pricing objectives is really the first thing that you need to do, but it's also the most difficult thing you need to do. And so we're going to spend quite a bit of time in this session talking about setting these pricing objectives, breaking it apart into not only what's happening in the futures market, but then also what's happening in the cash market through basis. So when we look at setting these pricing objectives, first we have to set the right set of expectations. And I get this a lot where farmers get really frustrated saying, boy, I sold too soon and prices kept going up. Or I saw prices going up and then they tipped over and came down and then I had to sell later on. So I missed the high of the market. And folks, what I'm really if there's nothing else you take away from this, it's hitting the high of the market is essentially impossible. And so if you're using the high of the marketplace as the reference point, whether you did a good job or a poor job of marketing, man, you're set yourself up for failure. Because setting that high, using the high of the market is just impossible. So it's very unrealistic. Don't use that as your reference point to decide whether I did a good job or not. Because the problem is you really don't know what the high of the market is until after the marketing year's over. So how do you know, how can you have that as a reference point? Plus, when we look at the probability, the odds of actually hitting the high, it's almost zero. It's almost zero when you think about all the trading that's going on, all the price volatility in particular now that we're seeing in the marketplace. The odds of you actually hitting the high, I would argue, are less than the odds of winning the lottery. So again, the point is, don't use the high of the market as your reference point. How do you determine whether you did a good job or not? The high of the market is really, really a bad reference point. So I'm going to try and ask you to change your question. So when you're looking at a marketing plan and setting these pricing objectives, what we're really trying to answer is, at what point would you be willing to sell more? And again, we really recommend that you make sequential sales over time. And there are obviously time periods when you have a lot more price volatility or a lot more opportunity to be able to hit higher prices. So we do have to look for those timing opportunities, which is also part of the marketing plan process. But the question you really need to ask yourself is, at what price would you be willing to sell more? And in today's market in particular, you do need to separate in your mind what's going on in the old crop prices versus what's happening in the new crop markets. Now, yes, those two are interacting. So what happens in the old crop influences new crop and vice versa. But from your marketing plan standpoint, especially in today's markets, because they're inverted, we need to be thinking about this old crop versus new crop price spread. So another way of thinking about this, and I've actually done this in meetings, is at what price would your neighbor be willing to sell? So let me tell you one really quick story to give you an idea of what I had in mind. And this is really a very specific example. I was at a meeting in Minot. We were talking about the Durham market. And there was a relatively small group. And so I asked this question. I said, well, when would you be willing to sell? At what price would you be willing to sell some more of your Durham? And the gentleman in the front row threw out a number. You know, the current price was about $6.50. He said $9. He wouldn't sell until it was $9. And the guy right behind him said $7. Well, who do you think is going to have the sale? Because what happens is, not only the cash market, but the futures market, as prices go up, we're doing two things. We're starting to ration the use. As prices go up, there's fewer and fewer buyers, but also as prices go up, there's more and more sellers. And so if you set your pricing objectives too high, say, boy, I'm going to wait for $17 in the futures market for soybeans, and I'm not going to sell another bushel until then, you might be waiting a really long time. Okay, so part of this is mentally thinking about where would you sell some more, but more importantly, also where would someone else sell it? At what point do you think this market, where those upper ranges? You don't have to hit the high, but you do have to hit those upper ranges. So the goal has to be realistic. You have to set some realistic expectations about the future. And that's really what we're going to talk about this morning, is these two different systems that are commonly used to set those expectations. One of them, again, is the supply-demand side, which is called fundamentals. And the other one, which I'll talk about a little bit later, is the technical analysis, or what we call charting. So there's two different kind of schools of thought, or different ways to try and set these expectations. And again, one more time, no one can accurately predict the future. We're all trying to play the odds. And so another way of phrasing this is, okay, given what we know today, what do we expect to happen in the future? And saying, well, what are the odds? What's the probability the prices will increase or decrease from here? And I often get this question from farmers saying, hey, I think I'm going to try and sell something. What do you think? And we start talking through, okay, what are some of the changes in the marketplace that might cause prices to go higher versus prices to go lower? And then you have to be thinking about, well, given that set of conditions, given those things that might happen in the future, what are the odds or probabilities that could happen? I mean, I can get you to much higher prices in the soybean market, but there's going to have to be a sequence of events, about 3 or 4 things that will have to happen in the right sequence to get you to those very, very high levels. The same thing on the way down. I can lay out a scenario. I can lay out a set of possible conditions where prices would drop and drop fairly quickly, but it would have to be a sequence of events that occurred. And then my question is, what are the odds? What's the probability that each one of those would occur in sequence? Okay, so we're going to start talking again about the supply-demand stuff first, which is, for most farmers, Most marketers probably the easiest because we understand the supply and demand side. We're used to thinking about what's going on in the cash market, and in particular, this flow of grain through the cash system. So there's three basic ways we can do this. First of all, of course, is to know your cost of production. Now, in today's world, your cost of production per bushel, now this is, you got to do the math a little bit differently. Instead of your break-even costs on a per acre basis, we're looking at what your cost of production is, including a return to your labor and management, kind of a profit margin, on a per bushel basis. And I know that gets to be a little challenge, not knowing exactly how many bushels you're going to produce this year. Okay, but understanding what your cost of production is one of those pricing objectives. Saying, look, the target is to try and sell all of my crop above the cost of production. Not a problem, right? Well, in today's world, it's much easier than it has been for the last several years, because there were a lot of pricing opportunities were much lower than your cost of production. Now, I don't, again, in this session have a lot of time to go through the kind of the mechanics of how you do that, but there will be other opportunities in the future. So we are going to talk about the next two, though, the fundamental analysis and the technical analysis. Fundamentals will be this right away, this first one. We're going to look at those supply-demand conditions. And we're going to specifically talk about the USDA WASDE report. So the WASDE report is the World Agricultural Supply Demand Estimates. These reports are projections from USDA that come out and are updated once per month. And now I know a lot of people look at those reports and there's a lot of criticism about, oh, USDA doesn't know what they're doing, or their numbers are really wacky. So I'm going to take you through the steps, the process that USDA uses to prepare this information. And it does change throughout the year because we do have new information that comes along. So I'm going to kind of blend, how does USDA do this? What is the current information, and what are some of the things as we move forward that might change our viewpoint or change the set of expectations? Now, one of the things that, again, USDA gets a lot of criticism for is that when USDA reports this stuff, the markets adjust, either upwards or downwards. And again, I want to emphasize, when you look at the historical relationships, there's about a 50-50 odds. I know that's for most of you think, oh, every USDA report prices go down. But if you actually look at the information and look historically what's happened, in most cases over the last 20 or 30 years, there's about equal odds it will go up or down. Sometimes there's a slight bias one way or another depending upon what the report is, but it's very close to equally balanced. Okay, now why is it that the USDA reports cause so much movement in the marketplace? Well, they're still considered to be that common reference point. Okay, and one of the things that I want to emphasize, USDA is a very large organization or agency, has access to a lot of information. They spend a lot of money trying to collect that information and put it into a format that's usable. Now, there are private companies, there's private analytical firms that will do the same thing. They will do their own independent forecasting. The big difference between a private firm and the USDA is the USDA information is public. So when they release it, everybody globally, and I emphasize globally, has access to that information at the same moment. Private analytical firms will do their own analysis, but if you want access to that, you've got to pay for it, especially when it comes to first release. If you want to wait 2 weeks to get the information, that's fine. They usually give it away for free. But if you want it right at the moment, at the most important time for making decisions, you got to pay for it. The other thing that happens is USDA has very transparent in the process they use. So they're not really hiding anything. We don't know the exact equations. We don't know the exact math. We don't know what their numbers they're going to provide us, but we do know the process they use to get the information. And so if you have a problem with the process, or if you think USDA is doing it incorrectly, you can make those adjustments if you understand the process. On the technical analysis, we'll get to that after break. So let me just dive right in, and I'm going to use the soybean supply demand estimates, the tables that were updated last week in March. Now I've got several columns of information that I want to use as comparison. So the column on this far left-hand side, this first column, 2019 and 20, that was the information from the crop year 2019. So that was the crop that we planted and harvested in 2019, and then we sold during the marketing year from 19 into 20. So for soybeans and corn, the marketing year starts on September 1. The marketing year for these crops usually start just before harvest, and I'll explain why that time period is so important. The column in the middle is the current USDA forecast for the 2020 crop, the crop that we harvested last year. This is old crop. So this is the crop that's still in the bin or hasn't been marketed yet. And then we did receive some information now. These are the initial forecasts from USDA from their Outlook forum. So the OF just means Outlook forum. So the column on the far right-hand side in blue, all of these numbers are mathematical forecasts. So there's no farmer surveys, there's no other information other than, given what we see in the marketplace today, the current estimated cost of production, farmers' historical decision-making process, mathematically, based on history, what do we expect to happen as we move into this 2021 cropping year, which is the crop that we're going to plant this spring. So I'm going to go through this table. Just to start out, again, is broken into two pieces. The top half of the table is the supply side. So we're looking at the inflow of grain into the U.S. system. The bottom is the outflow of grain. How quickly are we using those bushels up? And depending upon the crop, these categories for use vary just a little bit. Okay, so let's go through let's start up kind of at the top and work our way down this and understand, where does USDA get this information? How do they process it? And more importantly, when it's released into the marketplace, how can you use that information to try and do a better job of marketing or sales? Okay, so let's start with planted acreage. And we're now in this time of year where planted acreage, especially for 2021, is going to be hotly debated. So the initial estimates, when USDA first comes out, for example, in that column on the far right-hand side, the USDA won't release their first official forecast for 2021 until May. The ones that we got in February were rough estimates. The first official estimates will come in May. So in May, the planted acreage will be based off of this prospective plantings report, and that's going to be released on March 31. So again, mark your calendar, circle that date, because that date is going to be really, really important. Now, how does USDA get this prospective plantings report? It is literally a survey of farmers. So there's approximately 83,000 farmers across the United States that are surveyed. Those surveys are starting to go out now in the middle of the month and say, what are you intending to plant? We know this can change. We know it'll change based off of market information and changing prices. We know the weather can have an impact. But given what you know today, what acres of each crop are you intending to plant? They collect that information by state. They average it across the state for the different crops, as well as nationally. So March 31 at 11 o'clock a.m. Central Time, that's going to be released to literally the world. And trust me, there are international buyers that are equally interested in how many acres of these different crops we're going to plant. So notice, kind of from a current situation standpoint, we've had a slow building, a rebound of planted acreage in soybeans. And later on, I'm going to have a chart that shows a longer history than just these 3 years. Obviously, in 2018-19, we had a major cutback in planted acreage because of the U.S.-China trade war. We saw a slight rebuilding last year of 2020 because we started getting that phase 1 agreement that came into play. And the current expectation, because our ending stocks are so low, and I'll get to that in just a moment, we're seeing again another increase in the expectation. Again, this 90 million acres sets kind of that bar. Even though there might be private analysts that have different numbers themselves, whatever USDA comes with usually becomes that point for negotiation. So the argument becomes, well, if USDA says it's this number, what do I think, either as an analyst, as a farmer, as a buyer? Do I think that number is too high or too low? And what's the justification? What's the reason that I think USDA is wrong or has missed the mark? Why are my expectations different from what USDA is saying? So understand, please, now this 90 million acres, again, that's all based on mathematical forecasting. On March 31, we're actually going to get survey-based information. And I guarantee you that the grain markets will be extremely volatile when that number comes out, because there's still a lot of uncertainty right now today on what are farmers actually thinking. Yes, we can do the math on the different crop budgets. We can look at the drought monitor maps and say, oh, I think farmers are going to do this based on soil moisture conditions. Well, until we get the survey information, this is all speculation in the part of analysts or the traders. So this March 31 planting intentions is going to be really important. Will that number be higher or lower than 90? That's really the question. And we won't know that until the report comes out. So let's keep moving. In June, now as time marches forward, so in June, USDA will do another survey, a follow-up survey of farmers across the US, about 69, 70,000 farmers, a little bit smaller, and say, what did you actually plant? Okay, so you got the March 31, which is what your intentions were, versus the June report, which is what did you actually see? Now, again, because of the timing of that, especially the last couple of years where we had a lot of prevent plant, that number has really been focused on a lot. It's like, well, did farmers switch because of the delayed planting, because of the wet soil conditions? So the Acreage Report is the name of that report. So the Acreage Report is quote unquote actual production. Now, later on, USDA will go through and cross-validate, cross-check the survey information that's going on from NASS, the National Agricultural Statistics Services, with other divisions of USDA, including RMA, Risk Management Agency, that's in charge of the crop insurance program, as well as FSA, Farm Service Agency, that's part of course, the Farm Program Administration. And I'll talk about that in more detail in a second. So what's this difference between the planted and harvested acreage? In the case of corn, that differential is much bigger, primarily because of corn silage. There's a lot of corn that's planted, but is not going to be harvested for grain. In these supply-demand tables, especially for corn, we're trying to calculate the bushels that are available for use either within livestock feeding or the ethanol sector or for exports. So we have to subtract out those acres that are harvested for corn silage. Now, in the case of soy or soybeans, the difference between planted and harvested acreage is primarily failed acres or some kind of abandonment. It could be they were planted and drowned out. It could be they were hailed out because of weather conditions. Last year, we had the derecho storms that came through the middle of Iowa and caused a lot of crop damage. Well, those would be failed acres. So the difference between planted and harvested acres are failed. Now, early forecast, because we don't know what that's going to be, we look at kind of that historical norms. Percentage-wise, about 98% of the acres that are planted are actually harvested, knowing that there's some years it'll be above that, some years that'll be below that. So again, this difference is basically those failed or abandoned acres. Now, when we look at the initial estimates, again, as I said, they were based off of historical relationships, kind of on average over the last 10 or 15 years, what do we normally see for abandonment? The final acres for harvested, the final harvested acreage, again, is based off a survey of about 80,000 farmers, a little over 80,000 farmers, after harvest is completed. So the survey is usually done in November and December. The information is published then in mid-January. Those become those final official planted and harvested acreage. So sometimes we see late in the season some small adjusts or tweaking, again, depending upon what happened because of weather. This final crop, this annual crop production number, is the primary source of information is farmer survey. So they're asking you folks, what did you actually harvest? But they do cross-check. So USDA not only has the survey information, but they cross-check with FSA and RMA to say, look, do these numbers match? Now, the acreage numbers are never identical because there are people in the US that do not take crop insurance. And there's also farmers in the US that don't enroll in the farm program. So even though we have very high participation up here in North Dakota and Minnesota for both crop insurance as well as farm program participation, those numbers don't change a lot from the different survey methods, But if you move into other parts of the US, those numbers can be very different. So on a national basis, they never exactly match up. Okay, so there's always going to be this, well, did they get the number right? In my assessment, in my viewpoint, they're coming very, very close to the actual number, the correct number. How about yields? Oh, my Lord, have I had questions about yields? You know, where did USDA get this number? How do they do this? What, you know, what crazy things are they smoking to be able to get these numbers? Well, there is a process that's used, and I do want to explain a little bit about that process. Now, the other thing that happens when the USDA WASDE report, that World Agricultural Supply Demand Estimates come out, at the same time during the growing season, we also have a production report. So the days that the WASDEs are released, the production report is also released. The production report provides detailed forecasts by state, by crop. Now, those numbers are included, the revised numbers, if there is revisions from the production report, is included in this WASDE report, the supply-demand side. So the numbers do match, but the production report is watched very closely, especially during the growing season. Again, what kind of yields are we looking at from a national standpoint? So the initial estimates, for example, that 50.8 bushels that USDA kind of forecasted for 2021 is based off of a trend line. Okay, so we're looking at history, we're looking at historical yields, and we're adjusting for technology, the fact that we're doing a better job of farming. The science of agriculture is getting better and better every year. And so on average, our yields continue to climb up. And I'll show you a graphic in just a moment. Now we start there. So we're basically looking at it at an average yield to begin with, because we don't know what else to use. Now throughout the growing season, USDA uses three main sources of information to try and say, well, is that number, are we above or below average? So they use farmer survey information. They use what's called field data. They actually later on in the season, they send out, they hire individual workers to go out and take samples, their own independent sample of fields, just like a crop insurance agent would do to try and estimate yield. But they're also using a lot of satellite imagery. And USDA has been using satellite imagery not only for forecasting yields, but more importantly, to cross-check acreage and planted acreage for 20 plus years. And so they're starting to get the science down pretty well to match up what is happening based on the satellite imagery versus what's actually happening in the field. And I'll show you some information in just a moment just to reinforce that. So USDA is actually using for yields 3 different sources of information: farmer surveys, satellite imagery, as well as field checks. Now the field checks don't happen until later on in the year. The final numbers, so if we were to look back in time, how did USDA come up with that final yield estimate? Again, it's primarily based off of a farm survey, but they do cross-check it, as I said earlier, not only from a harvested acreage standpoint, but also from a yield standpoint. They do cross-check with the information from FSA and RMA. Again, they're not looking at individual farmers and saying, oh, this farmer answered this question, you know, the yield was 45 bushels in this, and they've reported 46 over here. That's not what they do. They're looking at what is the county averages, what's the national average, or the statewide averages based on these different data sources. Again, acknowledging that not all of the farmers that report on the survey are also enrolled in the farm program or enrolled in crop insurance. So the final official numbers, again, come out in that annual crop production survey or report in mid-January, just when we get those final planted and harvested acreage numbers. So let's look at trend line yield. Now, one of the things that USDA did a couple of years ago is that there's this mathematical trend. So the red line that bounces around is this national average yield going back to 1991. So they usually take about a 30-year average. The blue line that runs through the middle of it is that trend line. So mathematically, there's a way that we can calculate what that blue line would look like. So essentially what they're trying to do is take a straight line running through all those data points from the historical average. It's called regression analysis. So there's mathematically, there's a way we can calculate that. Now they do take one of the refinements they made a few years ago is they use that forecasting line, that kind of adjusting for trend line, but they also adjust it up or down a little bit based on planting progress. So if the planting progress is ahead of normal, they'll take that blue line and adjust it up just a little bit based again on history. Or if planting progress is behind normal, if it's slower than normal, they'll start to reduce that just a little bit. So they are trying to refine their systems of coming up with at least the initial forecast. Notice that on my line, it's just a little bit for 2021, just a smidge or a small amount below 50 bushels. If I go back, the trend line or the forecasted yield for the trend line essentially for 2021 is slightly above 50 bushels. I think based on the dry conditions that we're seeing, especially in the Western Corn Belt, that USDA is adjusting that number up just a little bit based off of early planting progress or fast planting progress. So this is the trend line yield. We're just taking average and we're adjusting for technology and the fact that our farming practices are getting better and our average yields are increasing. Now, throughout the year, I also mentioned that the USDA uses these satellite imagery. Now, based on the satellite imagery, they're also trying to back calculate and say, well, based on what we see and the progression of crop development, what can we use as a forecasting method, what the final yield might be. Now, this is some information that was published last year in August. Again, there was a lot of concern and question about what did those storms running through Iowa, what did that mean for corn yields and for soybean yields? And so they were publishing this as a way to try and show folks that, hey, we're doing our best to compensate for that. So this is actually the output, not the input, but the output from their modeling. Again, they're using the satellite imagery to try and forecast yields. The darker the green just means that you have a higher average yield. So they can identify where are the fields of soybeans, and based upon the reflectivity, they're trying to make an estimate of what the yield is going to be. Again, this is just additional pieces of information that they're using to validate the survey information they're getting from farmers. Okay. So within the growing season, that last step, I said there are three sources of information. You've got the farmer survey, the satellite imagery, and then you actually have individuals that are cross-checking yields. So when do those cross-checks start? When does USDA send people out to randomly assigned fields and they do actual yield estimates just like a crop insurance adjuster would do? Well, for hard red winter wheat, that happens in May because that's coming up pretty soon now. Again, the crop is developed enough that they can make some pretty accurate yield estimates. For hard red spring wheats, it's in July. For corn and soybeans, it used to be in August, but they dropped that August survey because it just wasn't reliable enough and it cost a lot of money to do. So they shifted to starting in September. So starting in September, USDA will send out actual employees or individuals that have been trained to look for and try and estimate what the actual yield is for spot checking on some random fields. Again, this provides information so as we get closer and closer to harvest, that yield forecast coming out of their offices will be as accurate as possible. Again, we can still have arguments over whether that's the right number or not. And obviously the marketplace is going to have a big debate and discussion about that, but I'm just trying to explain the process that USDA uses. So to get total production, pretty simple math. You should be able to take a calculator. If you take the harvested acres times the yield per acre on a harvested basis, you should be able to get the total production number. This isn't rocket science, right? So, but those two numbers, obviously, for not only the planted, but more importantly, harvested, as well as yields, have a huge influence on production. And as you notice, that production number is the major source of supply into the U.S. system. So the yields and the acreage obviously make a big deal on how much grain we have available. However, so again, let's just talk a little bit about the forecast now for 2021. Based on, again, forecasted national average yields, and it's a trend line yield, so that yield goes up a little bit every year. So I've heard a lot of kind of reporters or folks that in the nationals in particular saying, oh, USDA is forecasting another record corn yield or another record soybean yield. Well, yeah, it's because the trend line keeps going up. I mean, we're doing a better job of farming every year. So if we take the numbers that came out in that blue column, we look for that. If those numbers are correct, and just for reference point now, the 2021-22 production year would be a new record. We produce more soybeans in the US than we ever have before. Okay, so a combination of both yields as well as planted acreage. And we're up about 2.2% above the 2018 number, which was our previous record. So, you know, in the scheme of the global context of soybean supplies, you know, a 2 to 3% increase either in Brazil or in the US is a pretty big deal because we're the two largest producers and exporters of soybeans. So another source of supply, the grain that we would have available to use obviously is the ending stocks. We never totally run out of crop, right? We always have some bushels left in the system, whether they be owned by farmers, whether they be owned commercially, whether they just be in transit. There's always some bushels left over at the end of the year just before harvest, right? So this bottom line number, these ending stocks, is either an actual reported value or an estimate, a forecast of how much grain are we going to have left in the system just before harvest. So the ending stocks from the last marketing year get carried forward into the current marketing year. Now, the green column, the top half, we know. The top half is not going to change. The production numbers have all been locked in. We've got that January report, so they're not going to change. Whether we agree or disagree, those are the numbers that are going to be used. We still have some variability or some uncertainty about the bottom half, the usage, because we're only about 6 months into the marketing year. So we're about halfway through the cycle for using up the soybeans we have available. So on the usage side, which I'll get to in just a minute and explain how USDA comes with those usage numbers are, you know, we have about half of the information is real, and the other half we're just trying to forecast what's the next 6 months look like. So that 120 million bushels on the very bottom of the green column is still a forecast. But for the math, the process, we're going to take that 120, we're going to bring it forward into this 2021 marketing year. Now, again, that won't start until September, just before harvest. So when we think about the total supplies available, we have the inventory, the stuff we brought from last year, we add it to our production, we add in a little bit of imports, and we come up with our total supply. And I'll go through the mechanics kind of how USDA finalizes that bottom line number in just a moment. But the issue is we're still trying to figure out all available supply. And again, production is the major portion of that. So the ending stocks from one marketing year get brought forward into the next marketing year. Now, what about imports? In the US, we really don't import a lot of crop. We import just a little bit of soybean, we import a little bit of corn, we import a little bit of wheat, but it's very, very small quantities relative to our total use. Now for 2020, the old crop marketing year and the new crop marketing year, we're going to have a debate about these corn import levels. And so I want to touch on this just a little bit because you're going to start to hear reports coming into the news now about some soybeans from South America being imported into the United States. And those reports have been kind of floating around. We haven't had official confirmation because those bushels have not arrived in the US yet, but they are expected to. So we do import a little bit. They were likely, those soybean bushels from Brazil coming into the US will likely be imported and used in the southeast part of the US. So given the very, very tight supplies we have in the US right now, and we're trying to extend those supplies until harvest of 2021, there are parts of the US that it's cheaper and actually more efficient to be able to bring in Brazilian soybeans by ocean than it is to try and transport them from, let's say, Iowa or Nebraska by rail into those southeast locations because of the competition right now, the intense competition going on not only between the export market, but also domestic crushers. And we'll talk about that in more detail. So my point, if you look at what we saw in 2019 versus what the forecast is for 2020 and 2021, we are expected to import some more soybeans. You will be hearing about this in the news. I just want you guys to put the numbers in context. Yes, it will likely happen. It's going to make news, but when we look at the total volumes, it's still a relatively tiny number compared to our other sources of grain. So the initial numbers, this 35 million bushels in blue, is a forecast. That's just a mathematical forecast based off of history. So normally when our ending stocks get to be very, very small, we do import a little bit because of these differences in logistics. However, as we go through the marketing year, we do collect information. It's not only, it's actually the Department of, it's not USDA, the Census Bureau records all of the imports and exports. Okay, so for exported numbers for soybeans that are leaving the US, those are counted and scored and kept track of on a weekly basis. The same thing for imports. So they're tracking how many bushels are imported and arrive within the US and are going to be used domestically. So as the marketing year goes on, those numbers become very, very accurate because we are literally counting all the bushels that are entering and leaving the country. So there's a mandatory reporting system. So the final numbers are probably, as of all the numbers on this, probably as accurate as anything. Okay, now the forecasted numbers, of course, can have a lot of error in them depending upon what happens. So when we look at total supplies, you simply add everything up. You look at beginning stocks plus production plus imports, and you have total supply. Again, the math gets pretty simple. So let's talk about usage. So for old crop soybeans, what we're really focused on right now is the usage. How quickly are we moving through our inventories? The supply side is done. Now for 2021, all of the numbers we're debating is saying, well, what's the most accurate number, or what do I expect to happen in 2021? So how do we use up soybeans? The blue line is for crushing. It's domestic crushing. Crushing into oil and meal. The oil and meal is used both domestically as well as exported. The red line is exports only. So that's the exports of whole soybeans. So those are unprocessed soybeans. And you notice that we've had a lot of volatility in the exports number the last several years, primarily because of, again, the US-China trade war. So how does USDA track this stuff? How do they try and make sure that either their forecasts are as accurate as possible, or when we get the final numbers, that the final numbers really do represent what's going on? So again, early on, as we look at the numbers for 2021, these are all forecasts. These are based on expectations of domestic demand and local demand. And international demand, excuse me. I'll be very honest with you. When I talk to private analysts, or as I'm trying to do something similar in my own forecasting, getting the numbers for production are probably easier than getting the numbers or putting the forecast together for usage, because the usage part, because of both domestic crushing or domestic use as well as international use, gets extremely complex. So a lot of times, if you listen to the criticisms that private forecasters have about the USDA numbers, a lot of it has to do with the production side. It's very rare that you see discussions or debates about the usage side, in particular domestic use. We do sometimes have debates about the exports number, and I'll go through a reason why in just a moment. My moral is that forecasting the usage numbers is very, very difficult. There's a lot of moving parts. There's a lot of variables, a lot of things you got to consider in trying to put these forecasts and these numbers together. As I said, every month USDA reforecasts this based upon the new information we have. So the blue, just to reiterate, the blue column, that's all forecast based on what we expect to happen in the future. The middle column, the green, we have about 6 months worth of actual information and about 6 months worth of forecasts. So based on the trends we see so far, and any kind of seasonal behavior or seasonal pattern, what do we think the final number will be by the end of the year, by September 1? And then the column on the far left-hand side in black is the actual number. Okay, so that's kind of the final number. It won't change. So where does USDA get this information? Well, every month they do a large industry survey. It's called the Fats and Oils Report. They have a large survey of crushers, all of the crushers in the United States. They survey once a month to say, look, how much are you processing? How much you've been processing. We can track exports because the Census Bureau tracks that information. We can track imports through the Census Bureau. But USDA a couple of years ago started doing their own survey work again. So many years ago, they had their own surveys. They took a break because of the budgets were cut, and they relied on industry information, NOPA, which is National Oilseed Processors Association. So there's a Processors Association that does also a survey. And because of some budget issues, there was a time period when USDA used that NOPA number, the industry numbers. Now, the industry participants, the people that are surveyed, they're only those NOPA members. So there were some processors that were not part of this association, trade association, that were crushing and were not included in this industry survey. So for a while, USDA was using that industry survey and just kind of ramping up or increasing proportional based on history. Well, once what they found was their forecast started getting more and more incorrect. There was more and more error starting to show up in their forecast for total usage, which then influenced what the ending stocks was. So they rearranged their budgets, they rearranged their priorities and said, look, we have to continue to do this fats and oils survey so that we have our own information and we can look at the entire spectrum of the industry. And what they found when they started surveying again was that the percentage, the amount that was of oilseed crushers that were part of that association had increased. So they went from about 75% of before to about 80 or 85% after. So we are getting more information, we're getting more accurate information, and therefore at the bottom line, I know a lot of farmers get kind of critical of saying, well, boy, where did USDA suddenly find all those bushels? Well, part of it is the process they were using to try and track the use throughout the year. Okay, so I just want to explain really quickly. Now USDA is doing their own work, their own survey work to try and get as accurate information as possible about the domestic crushing industry. So let's talk about the numbers really quickly. In 2020, the monthly crushings have been setting new records. So the domestic crushing industry is a very large portion of our consumption right now. They're also, the profit margins in crushing throughout the US have been very strong for the last, well, 12 to 18 months. I mean, it goes up and down depending upon market prices, but the crushing profits have been very, very strong. So we're setting new crushing records. And that's really not only a rebound and expansion of the export demand, but this very strong increasing and growing domestic crushing capacity is also using up soybeans very, very quickly. Now, because of the profit margins and the current industry is running near maximum capacity, there's a lot of talk about expanding the crushing industry or crushing sector. And I've heard stories about a lot of feasibility studies going on right now to expand and build some new crushing plants. Now, not all of those feasibility plans are going to be implemented, but we do expect in the next 12 to 18 months to hear announcements about additional crushing plants nationwide being constructed, and again, using up more soybeans domestically. Some of those crushing plants are to meet domestic needs. Some of that is to try and meet the expanding international markets. Now, whether those are located within our region or not, I have not heard. So I'll just superimpose. I have not heard anything about things happening locally, but it would not surprise me to hear stories that there are some people talking about it. Okay, let's talk a little bit more about biodiesel. And this is one of the driving forces now behind the current profitability in the soybean industry. Biodiesel is listed as an advanced biofuel. And right now today, about 30, well, call it a third, between 30 and 35% of the soybean oil is used for biodiesel. The reason that's important is because California recently changed their standards and they have kind of a cap and trade policy for their carbon, biodiesels and advanced biofuels, it scored differently on this carbon emissions calculation. And so there's a lot of interest, in particular from California, for including more biodiesel in their fuel supply to be able to meet the requirements going on in California. So some of this growth and profitability that's in the crushing sector, not only driven by very strong crushing demand for soybean meal, but also on the oil side. So seed, initial values are forecast based on kind of expected plantings. The final values, they're doing surveys of seed dealers and trying to get an idea of what the actual usage was. So seed number, again, relatively small, but it does fluctuate based on planted acreage. So what is residual? And again, this becomes kind of a hotly debated topic. So residual, in the technical sense, residual is spoilage and wastage. Okay, it's those bushels that were harvested but never really make it to the consumption part. Now, in reality, some of that residual is actually also rounding error. So if we have some error in our forecasting, either on the production side for acres or bushels, or on the usage side, that also gets embedded in this residual. So it's that number we use to try and make sure everything balances, because this is like a balance sheet. All of the inflows have to match all of the outflows plus what we have in storage. Now, the vast majority of that, I want to emphasize, the largest portion of that number is for spoilage and wastage, especially for soybeans. For corn, we can that's hotly debated, but for soybeans, this number is something that is published. Most of that is spoilage and wastage, but there can also be rounding error embedded in that. So I just want to recognize that there is some buffer in here we have for making some corrections, and that can make a difference, especially as we get to those ending stocks numbers. We'll look at exports. Again, exports, very, very large portion of U.S. consumption. And I know you guys have if you're listening to the market news, if you're trying to understand what's happening, you understand that this export market for U.S. soybeans is critical to price movements. Now, the initial values, again, so thinking about the numbers in blue, those are forecasted based off of growth rates in population, growth rates in economies. As people have more money, they try to add more animal protein to their diets, which increase the demand base for meat products, which increases the demand base for feed products, soybean meal being a major feed product. So as I said, the forecasting process for coming up with about how many acres, how many bushels are we going to be able to sell in the U.S. as a U.S. industry relative to other countries like Brazil or Argentina is not only based upon, again, our relative production, but also what's that demand base and how quickly is that growing? Who do we traditionally supply? Okay, so this gets, as I mentioned, very complicated to try and keep track of. So this 2.2 billion bushels of forecasted exports in 2021 is all based off of those expectations about what we think was going to happen in the future. This middle number, 2.25 billion bushels, that's based off of a combination of actual reporting, because again, every week we get information on how many bushels have been sold and how many bushels have been delivered based on our export sales numbers. There's a report every week. About half of the information we know, and about half of it is forecast. The final numbers, the column in black, is a final official number, because again, we have been able to track that for the full 12-month period. Okay, so let's talk about who buys our U.S. soybeans. I won't go through this table in gory detail simply because it takes a while and we're running a little bit short on time. So China is our #1 customer for U.S. soybeans. Again, this is whole soybeans that have been exported. The column in the far right-hand column is the actual reported numbers for the first 6 months of our marketing year. All of the other numbers on here are 12-month totals. So all the numbers are 12-month totals except for the column on the right-hand side, which is actual numbers for both sales as well as deliveries, all of those bushels that have been committed for the first 6 months through last week, which is the most recent reports that we got. Please understand, and this becomes the challenge now for forecasting, is our export, and this is export shipments, not export sales. Export sales include all the contracts for delivery in the future. Export shipments represent the bushels that have actually been loaded onto a vessel. The red line is the current export pace. This just shows historically how much have we sold or delivered every week. You see this really big seasonal pattern. So as you're making these forecasts, you have to adjust for this big seasonal pattern. It's not a straight line. You can't say we sell the same amount of soybeans every month. So even though these totals get to be some very, very large numbers based on the information we have today, the expectation based on history is that this is going to start to drop off and start to slow as we get into the summer months. Another question I get is, okay, of all the sales that we made, the contracts, how much has actually been shipped? Well, about 12% of all of our sales have not been delivered yet. So there's the commitments, or the outstanding sales, is about 12%. So of all the stuff we sold, about 12% has not been shipped. If we look specifically at China, so far this marketing year, this is the pattern, very similar to what we saw on a national basis. Of all the sales we made to China, there's only about 3.5% has not been shipped. So is there going to be cancellations moving forward? You know, maybe you'll probably hear a little bit about that, but I don't think, based on the problems they're having in Brazil, we're going to see a lot of that occurring. I think the grain that has been purchased under contract will be delivered. So let's talk about total usage when we get down to the bottom. Okay, you simply add all those numbers up. It's just simply the mathematical sum of the crushings, exports, seed, and residual. So how do we get to ending stocks? Well, in the forecasting side, in this column in the blue, we take total supply minus total use, and we get an estimate for how much do we think we're going to have in the system just before harvest. Okay, the middle column, as I said earlier, in the green, is still a forecast. So there's some real information, there's some forecasted information. The column on the far left-hand side, that's an actual survey. So every quarter, every 3 months, USDA does a massive survey of all of the commercial handlers. We get all of the commercial handlers, and they do a survey at farmers, a subset, and say, all right, how much grain do you have on inventory on these specific dates? So every quarter, every 3 months, they do that. March 31, we're going to get another survey report from this quarterly grain stocks. Well, that quarterly grain stocks for September, we do a survey saying, how much grain do you have in the inventory on September 1, becomes that final number. And so sometimes we do, based on the survey results, get some adjustments in that forecast based on the real number. So we hit that reset button and saying, let's make sure we have the most accurate information. And as I said earlier, sometimes there gets to be some differences between what's actually reported versus what even towards the tail end, what the forecasts are. So we do see some adjustments based on the accuracy, not only of the usage numbers, but also the forecast for production. So if there's some error, or if there's some adjustments that need to be made either on production and or consumption, it usually comes out during that September, actually it comes out at the end of September, but it's the September 1 grain stocks report. So again, that inventory, when we have our inventories at its smallest level just before harvest, get carried forward into the next marketing year. If we look at this stocks to use ratio, and I use this a lot in my market talks about, you know, what's going to happen to prices next, we're looking at some extremely low numbers. So this 120 million bushels for soybeans in 2020, the old crop, that's a forecast, is about 2.6%, which is ties the record low we saw back in 2013-14. Now the current forecast, again, all of these are forecasted numbers in blue, is for a carryover stocks about 3.2%, which is still extremely tight. We look back historically. I'm just looking at that percentage historically. That's the blue bars in the bottom. This is the current inventory numbers for old crop, for the crop we're still trying to market. Here's our record low in 2013-14. As that carryover stocks number gets smaller, two things happen. Average prices increase and prices become a lot more variable, a lot more volatile. Okay, so I'm going to skip over some of this stuff just for the sake of time, because I do want to make sure we get to some questions. Let me just get to this acreage discussion really quick. So this is a graphic of historical planted acreage. Because the gold line on top is corn. That's corn plantings. The green line is soybean plantings. The brown line is wheat. The black line is cotton. And then the purple line is sorghum. Those are the top 5 acreage crops we have in the United States for annual plantings. Okay, notice back here in 2017 and 2018, we had about 90 million acres of both corn and soybeans planted in the U.S. The current forecast out of USDA, again, the initial ones, those first kind of initial guesses, is for about 90 million acres of soybeans and about 91 million acres of corn. So the question I'm getting is where all those acres are going to come from. And when you do the math on it, trying to figure out where, will we see a little bit of shifting in wheat, in particular spring wheat? Probably. But the number that people forget about is prevented planting. Okay, so this is prevent plant acres nationwide going back to 2007. So the gold line on top is the mathematical average for all of the years, including the last two, 2019 and 2020, which were very large. So remember, last year in the US, we had about 10 million acres of prevent plant. Now, given the very dry conditions in the Western Corn Belt, my guess is some of those prevent plant acres from last year will get seeded this year. The question is how many can we bring back into production? The blue line, I recalculated, said, well, what's the average of excluding these two really big years? So if you include the two big years, you get about 6 million acres. If you exclude the two big years, we get about a little over 4 million acres. So if we had 10 last year, and we're looking at some much smaller numbers this year, looking at, let's say, 4, we could easily pick up 6 million acres just in prevented plant. Just those acres that were so wet last year, we couldn't bring them into production. My guess is a lot of those acres will get into production this year. So I'm going to stop for questions. I ran over just a little bit. I don't want to take too much time out of break. So I'm going to stop sharing here. And Jenna, I suspect we've had some questions come in.
Frayne, we actually haven't.
Really?
I know. I put out the call for questions a little bit ago in the chat, and I haven't seen any thus far.
So let me just do a really quick recap of this section. So one of the reasons I wanted to go through this is I get a lot of questions from farmers about how does USDA do this? Why are the USDA numbers so different from what I think is going to happen? Well, I want to explain there is a process. They're very transparent about how they get the information. And I know that every time USDA comes out with a new piece of information, the markets respond to that. The traders and analysts, whether they agree or disagree, those are the numbers that get traded in the marketplace, okay? And so we've got to understand why that's happening.
One thing I thought of, Frayne, as you were going through some of the WASDE data, I saw, gosh, I think it was a week ago, that this spring they're intending to represent soybean oil as, I believe, 1% of what's headed into the renewable fuels market, because, as you said, about 30% of that oil is going into that market, probably only increasing. And so they said it was really quite historic to see a revision like that to the WASDE report.
Yes, yes. And again, so the point you're making is that as policies change, as the marketplaces change, USDA is trying to adapt. I mean, they're trying to provide the best information possible. And trust me, I know some of the folks that work at USDA that put these numbers together, And I guarantee you, every time they release new information, somebody calls them and complains that they're wrong. If the numbers come in and prices go up, farmers are happy, but obviously the processors and those international buyers, other domestic buyers, are really upset, and so they'll call and complain. Sure. If prices go down, you know, again, because of the new information, farmers call and complain, saying, "Wait a minute, what are you doing? These numbers aren't right." So they're constantly getting picked on and challenged to say, "How did you do this? And are those numbers correct?"
Sure. Well, we got a couple questions in on kind of USDA accuracy. So first question, does the USDA publish confidence intervals on their estimates?
Yes, they do. They do. Most of the time, unless you're really a statistical wonk like kind of I am, or a math person, you kind of ignore that. But they do publish that. If you go at the very end of each of the reports, if you go to the very end, they explain the process they use, especially if it's sampling, but they also report what is their mean squared error, which is just a measure of the accuracy of their forecast at that time relative to the final number. So yes, they do track that very, very closely. They try and get, as accurate as they possibly can.
Okay, very good. So then along those lines, who has a more reliable track record, the government data or private analytics data in general?
Well, it depends upon what you use as that base. Okay. I mean, if you're using that final USDA numbers as the base, as the point of saying this is the right number, and so we're going to look at what the private guys did versus what USDA did. It varies by company. Now, I haven't looked at all of the information, but I do know there are some companies, especially when we look at production, that have biases on the high end, and there's some companies that have biases on the low end. So whenever you see this range of forecasts for total production or for yields, there are some companies that are consistently on the high end of that forecasting range. There are some companies that are consistently on the low end. So just because it's a private forecast doesn't mean that there isn't some kind of embedded bias in it because of the kind of clients that they're working with.
Sure.
So I don't know the direct answer to that, whether there's a particular company that's more or less accurate than what USDA is coming. I just really haven't dug into the statistics enough.
Very good. Well, with that, that's all the questions I have regarding fundamentals. Do we want to take a break and come back for technicals? Okay.
Yep. Let's take a short break and again, a coffee break, a bio break to be able to give everybody a chance to recharge. We'll come back at about 9:15, and then we'll try and get going on the technicals.
All right. Sounds great. See everybody in 5 minutes, 9:15. All right, it is 9:15. I see we've got Frayne back here. And Frayne, we did have a question come in over break. So before you jump into the new stuff, can you cover a bit what you mean by inverted market and how that relates to what we're seeing today and the impacts of that?
Okay, and actually I saw the question come in as well.
Oh.
So the next section is going to talk a little bit about the charting techniques or the technical analysis. And I do have a slide where I can show the inverted market and we can talk just a little bit about what that means. So I'll try and cover that as we're going through the next section.
Sounds great. All right, with that, I'll let you jump right in.
All right, well, I'm going to share my screen one more time, make sure we get this up. Can you see that okay?
Looks good on my end.
All right, fantastic. Okay, so thanks for rejoining me. Now we're going to shift gears a little bit. So we're going through the fundamentals and the technical analysis. Technical analysis is really kind of the charting techniques, and I'll talk more about what that is and why it's important in just a second. So this first, just to explain a bigger context for the session, tomorrow I'm going to be taking a lot of the information we're talking about today as a setup, as kind of an introduction to the supply-demand conditions and how people use the information from the USDA, as well as these charting techniques, technical analysis. And tomorrow I'm going to try and bring these together and say, all right, given what we have seen and kind of the techniques and tools that we have in our toolbox, what are some of the ways that we can start setting some pricing objectives, setting some potential timing objectives, and talk just a little bit about choosing the different marketing tools available in our toolbox and why sometimes certain tools work really well at certain times. So again, in a bigger picture sense, I just do want to try and provide some context for why we're going through this detailed stuff, the mechanics of this, before we get into the actual analysis section, which will really come tomorrow. So let's just begin and dive right in. So we have these two different systems. We have these two different approaches to try and set some expectations about the future. We know what's happening today, but what do we think is going to happen next? And these charting techniques, the technical analysis, we're really looking at historical price movements, and we're focusing on what's happening in the futures markets. Okay, people have tried to use these technical trading or technical analytical tools in the cash market. And they do work, but it's not nearly as effective. They're really designed, and most appropriate use is to evaluate the futures market. So just let me understand, or help you understand, look, the futures market exists for a reason. Okay, so the U.S. commodity futures markets, and I'm going to talk specifically about the grain markets now, are very large, very liquid public markets. So when we say in my language, in my world, when we say it's a large market, what that really means is, translation is, we got a lot of buyers and sellers. There's a lot of people that are trading back and forth in this marketplace. If it's a liquid market, again, the general interpretation of a liquid market is that there's a lot of trading volume. So not only there's a lot of buyers and sellers, but there's a lot of product that's being traded back and forth. It's very easy to enter and exit the market. It's very easy to start buying or selling in the futures market compared to some other markets. And there's also a relatively low cost for using it. So it's not that you have to, I mean, you have to get yourself exposed and understand what's happening. You have to learn the mechanics. But once you've learned that background, once you have these basic tools, to actually be able to put your toe in the water and start actually trading is a relatively simple and easy process that's a low cost. So when we talk about a liquid market, we're saying there's a lot of volume of trading back and forth. It's also a public market, which again, in generic terms, means that the information about prices and trading volumes is very easy to access for a wide range of people. So to find out information about what's happening in the futures market is relatively simple. There's a lot of phone apps that you can get with a 10-minute delay. And we're going to talk a lot about why 10-minute delay is important. But you can get that for free, right? If you wanted to look up what's happening in the futures market right now, this moment, it would not be hard to find that, either through a web search or through an app that you already have. So what that means is the futures market becomes that common reference point. The futures market becomes that common point that we look to, that the cash market actually uses as a starting point. Okay, so if you were to talk to a grain buyer in North Dakota, or a grain buyer in Iowa, or a grain buyer in the Gulf, in the U.S. Gulf at an export terminal, or a grain buyer out of the PNW, or an international grain buyer, we're all going to start kind of our discussion about what is the appropriate price, what do we need to be able to get a buy and sell for actual cash grain. We're going to start that discussion with the futures market. So where's the futures market trading? What does that mean for our purchase and sale of actual cash grain? So that futures market, because it's so large, liquid, and public, is an easy reference point. So the futures market, the main reason futures market were created, the main reason it continues to exist, is actually for price discovery. It's saying, what is the value of this grain in the future? So if I, for example, we're going to talk a lot about November soybean futures, because that November soybean contract is used as that reference point by local grain elevators to say, okay, if I'm going to sign a contract, if you as a farmer are going to sign a contract with a local buyer for delivery at harvest, that buyer is going to use that November futures contract as the departure point for negotiations. Now, you might be able to negotiate basis levels, which is that difference between cash market and the futures market, which Dr. Wilson will talk about in a moment. But that price discovery is really the primary purpose for the futures market. Now, because as a result of the fact that cash markets and futures markets are very closely linked, that the cash market traders use that futures market as a reference point, now we can also use that for risk management. Because there's this really strong linkage between the futures market and the cash market, we can use that for risk management. So hedgers are attempting to reduce price risk. They see a price in the marketplace. You want to lock in that price for future delivery, okay? So we're going to use the futures market as a tool to be able to lock in a price. Now, a speculator, on the other hand, is someone who's attempting to profit from price movements. You're willing to accept that risk. And I'll argue, I know I'm going to be very sarcastic here, but I'm going to argue that pretty much everybody on this webinar, if you're a farmer and you have cash grain in the bin, you're just speculating in the cash market. You're not speculating in the futures market. Okay, so just because the term speculator sometimes has a negative connotation, but we actually need all of these traders in the marketplace, both cash and futures, to be able to make the markets work efficiently. So main reason we have the futures market is price discovery. The reason that the fact that the cash market and the futures market are so closely tied together, the cash market traders use that futures market as a reference point, allows us to do a lot of other things. It really opens up a lot of doors for some customized contracting programs and for this risk transferability. So what is a futures contract? And a lot of times, before I get into what's happening on the pricing side, there's actually still some misunderstanding about what is the futures market contract. It's true, a lot of people say, well, all they're doing is trading paper. Well, that's true. They're trading paper, but they're trading contracts. And these are very specialized contracts. They are legally binding contracts. I want to emphasize, these are legally binding contracts, but they're very, very specialized. So the contracts traded in the futures market are very different from the contracts you might sign with a local elevator or a local processor for the delivery of grain in the future. So in a futures market, they're predefined, standardized contracts. So the structure of the contract is very clearly defined, and in most cases, almost all of the contract provisions are non-negotiable. They're fixed. So the quantity of grain, the quality of the grain, the delivery point, where it's going to be delivered, when it's going to be delivered, are all fixed. You can't negotiate those. And I'll give you the contract terms in just a minute. But for example, soybean, corn, and wheat futures contracts are all for, one contract is for 5,000 bushels. If I want to sell 6,000 bushels, I can't negotiate 6,000 or 6,500. It's either 5,000 or nothing. The quality is predefined. When it's going to be delivered, where it's delivered is all fixed. The only thing we negotiate, the only thing we're trying to argue over is what is that price? Given the information we have, my expectations about what I think is going to happen in the future, we negotiate on price. Okay, all of the other terms are fixed. So what it really means is it becomes very quick and easy to negotiate price, because we don't have to haggle over the fact, well, I don't want it delivered during this time frame. I want it delivered in a different time frame, which means the price would be different because we have to adjust for this timing differential. Okay, so futures market, they're legally binding contracts. They're predefined. The only thing we're negotiating is price. Which also means it gets a little bit confusing is to say, all right, well, if I'm buying and selling a futures contract, I can actually buy or sell that contract. I can have a promise for delivery or a promise for receipt of that commodity without having any grain. So I can sell a futures contract, meaning I had promised to deliver grain without having any physical grain. But in many cases, you as a farmer are doing the exact same thing when you're contracting for the delivery of soybeans at harvest. Because in most cases, you haven't even planted the soybeans yet, right? But you're still signing a contract that's for the physical delivery in the cash market. The futures market is similar. Now, the big difference is by buying and selling, by promising to deliver or processing to receive in the future, almost all, not 100%, but almost all of the contracts in the futures market are offset. So I can buy a contract, meaning that I would be willing to receive, okay, and I can hold that contract for a couple seconds, a couple days, a couple months, and then I can resell that contract. And the fact that I bought and resold the contract in the same month, those two offset, they cancel each other. Now, physical delivery is discouraged. So there is a process in place where I can take a futures market contract, convert it into a cash delivery position, but that conversion process is very complicated, and it's not done very often. In fact, the futures market traders do not want that to happen. Okay, so don't think of this as, oh, I'll just buy a futures contract and I'll actually deliver on that contract, because that process is actually very complex. So the point is, every trading day we're negotiating. We're negotiating what we think the value of that commodity is at different points in the future. And it's a communication tool. So the futures market's communicating information about what, as a consensus, what all the buyers and sellers think the value is in the future. And so these different times for delivery are important. Now, the terminology nearby futures is usually the contract month closest to today's date. Okay, and I'll go through an example of that. So we're in the middle of March. The March contract has stopped trading now, which means the May contract is the nearby futures. So as we move through time, this nearby futures becomes a different number. Now this, I took a screenshot. This is as of the close on Friday. So all the information we're going to go through now is as of the close of trading on last Friday. Yes, the markets are trading right now, and I can show you some real-time information if you wish, but I guess for the ease and simplicity, I just wanted to do some screenshots to go through and talk about the process of using the information in the futures market to try and set some expectations about what I want to do and setting some of those pricing targets we talked about earlier. So if we look at this, again, this is a screenshot from ProfitX. It's one of the information tools we have available in the Commodity Trading Lab. In the far upper left-hand corner is the prices, the closing prices as of Friday for the different contract months for corn. So upper left-hand corner is corn, upper right-hand corner is soybeans. So notice I'm going to talk specifically about soybeans. So we have a symbol, the ticker symbol. I've included the month. So this would be for May 2021. We get July, August, September, November. That November contract, we're going to be spending a lot of time talking about what are the different historical price movements we've seen in this November contract, and how can we use that information to set some pricing objectives as we move forward in time. Now, there's a question that came about an inverted market. Now, normally, let's say For example, let's look at the wheat market, the spring wheat market in the bottom left-hand corner. Normally what we see, a normal market has a carry. So as you move further and further into the future, the prices tend to get higher and higher. And what that is signaling is saying, all right, this market is providing a partial incentive to store grain and deliver in the future. So as that price differential, as a price spread from one contract month to the next contract month, from May to July, as that gets larger, it's saying we're providing more of an incentive for you to store it and deliver it in the future. Or rephrasing, if I wanted to lock in a price today, I could deliver today, or I could lock in a price for delivery in the future. And obviously, as a farmer, you have storage costs. There's interest costs. There's the risk of the grain going out of condition. There's the cost of actually running the fans and making sure that you maintain quality. So that carry in the market is a signal to say, all right, what are we going to pay you from a futures market? How much are we going to pay you to store it and deliver it in the future? Because we need to ration out. We need to make sure that flow of grain throughout time is metered. Well, let's look at the soybean market. This is called an inverted market, where the price in the future is actually lower than the price today. So what is the futures market signal sending to you as farmers? Guys, we don't want you to store. In fact, if you want to store and speculate in the cash market, that's fine. You can do that. But just remember, we're going to give you a disincentive. We want the grain today versus sometime in the future. So the metering mechanism is actually running in reverse. It means that the available supplies today are much tighter. The supply-demand conditions for delivery immediately are much tighter than the supply-demand conditions as we move into the future. Now, one of the things I want to point out, of course, is we have the harvest, right? So November usually represents that harvest month for new crop. For the 2021 harvest, we're really looking at November. All of these other months are trying to ration the use for the crop that's currently in inventory, for the old crop. So sometimes we see this flipping or this triggering, this differential between what's happening in the old crop, metering out the usage of grain that we have in the system, versus the new crop saying, all right, what do we want you to plant in 2021? So this inversion, this fact that the market is discounting you or providing a disincentive to storing is unusual. It doesn't happen very often, but in the soybean market, we've started seeing this happen more and more over the last probably 10 or 15 years. Usually we have what's called a carry in the market. So we have an incentive to store it and move it into the future. So hopefully that answered the question that came in. I don't want to spend a lot of time on this, but I did want to provide some information. Again, you'll be receiving a copy of these PowerPoint slides. Again, these are just the basic contract specifications. So Chicago Board of Trade trades the soybean contract. It's 5,000 bushels per contract. We have these different delivery months. I also sometimes get questions about the trading limits. So in the futures market, there is a limit to how much, starting at, how much, beginning based on yesterday's information, how much prices can go up or down within a particular trading day. So we do sometimes we get this shock of information where it's like, boy, we didn't expect this. It could be because of USDA report. More than likely, it's something happened politically, internationally, where we have this shock of information and all of a sudden prices start to move very quickly and rapidly. The futures market has a safeguard in it saying, look, we're only going to allow the prices to go up or down a maximum amount in a given time period. And it's this safety valve to say, okay, don't overreact to new information. So 70 cents, and these limits are adjusted periodically. Right now, the trading limit for U.S. soybeans is 70 cents per bushel. If we do trigger that, if it does hit that limit, the next day we go into what's called expanded trading. So the prices can move even further, but there is a limit to how much they can go up or down depending upon this new information. So we have Chicago soybeans, you got Chicago corn, again, 5,000 bushel increments. The months are a little bit different than they are for soybeans. The daily limits are a little bit different because that base price for corn is a little bit lower. Soft red winter wheat is also on the Chicago market. Again, 5,000 bushels, very similar trading months to, identical trading months to corn. Trading limits are a little bit different. So this is called Chicago wheat, is the soft red. We have the Kansas City contract. So that's hard red winter wheat, but it's also now traded on Chicago Board of Trade. We have the the spring wheat market. Hard red spring wheat is traded on the Minneapolis Exchange. Again, it's a little bit different trading exchange, slightly different rules than they have in Chicago, but very, very similar. So given that as a background, how do we talk about technical trading or charting analysis? These are techniques that have developed over time. They originally started within analyzing what's happening within the equity markets, the stock market. And some of those trading techniques now have been adapted or modified to look at commodity markets like the energy markets or the precious metal markets or the grain markets. And basically what we're doing is we're using historical price movements as an indicator for what might happen in the future. And the reason these work, the core reason that these technical or charting analysis works is because we have humans, people that are buying and selling. Now, we do have in the world today what's called algo trading or computerized trading, but you still have people that are writing those algorithms. We still have people that are putting in the computer program to trade to say, if this happens, do this. If this happens, do that. So because humans are trading and humans have habits, we have our good habits and our bad habits. Really what's happening is we're looking at these price movements and trying to pick out patterns and patterns of behavior. So one of the ways to think about it is these trading tools, these kind of guidelines we're going to go through really reflect some human behavior. They reflect human habits and biases. As I said earlier, the futures market, it works relatively good. People have tried to use it in the cash market. It works, but not quite as well. So we're looking at price movements, we're looking at volumes, and we're looking at trading patterns. So let's go back in time and let's look at some bar charts. So a bar chart is simply provides information about what's happened in history. Now this is an older one. Actually, I'm sorry, I've got the wrong chart up here, but I'll correct it for the final version. This is really just a chart of historical price movements. Each one of those black bars represents a trading day. Now you can change the trading interval. You can have it to daily, which is the most common. So each of the bars represent a day. You can trade it to a week. So each bar represents a weekly time period. You can trade it to a 60-minute or a 20-minute or a couple second time period, depending upon what you want to evaluate. Most of the cases for you as farmers, we're going to be looking at daily price charts. So all I did was I zoomed in. I looked at, okay, let's look at the November soybean futures contract over the last about 2 months, and we're going to look at the daily price charts. So each one of those bars, each one of those segments represent 1 day of trading, and we're going to look at what is the information contained in this chart. Okay, so this just shows what's happened to prices over time. I've just zoomed in for about the last 2 months. Now, I'm going to isolate 1 day. So each one of those little tick marks, each one of those little bumps represents something. So we start on the left-hand side. There's a little bump that represents the opening price. So that's the first trade of the day. So the first trade where buyer and seller actually came back together and traded, that's the price for that first trade. So that's when the market's open. Okay, so that's the first trade of the day. The top of that bar represents the highest price during the trading period. The bottom represents the lowest price during the trading period. And then this little bump on the right represents the close. So we're always moving from left to right. So the left is the oldest time period, the right is the newest time period. So for each trading day, we have a lot of information about what happened during that time period. Okay, and so if in this example, in the example I just went through, we had actually a decrease in prices. So the traded opened at one price level at about 12.37. Prices dropped to a low of about 12.25, 24 and a half. It rose to a high of 12.55. And then it closed, the last trade of the day was actually at about 12.30. So that was a pretty wide trading range. So each one of these gives us some information about what happened that day. If we go back in time, there was a couple days where we had an extremely wide trading range. So the price movements in a particular day were extremely wide. And on this particular day, at kind of the mid to end of January, we had a trading range of about 11, let's call it 11.11, all the way up to a high of about 11.63. Huge trading range, big volatility during that trading day. And then we have other days back here where we had a very narrow trading range. In fact, there's one day where the price opened, we traded during the trading period, and it closed at basically the identical level. So we use this information then to try and say, okay, based on history, what do we see happening in the future? So the simplest way, the first couple of kind of techniques I'm going to show you are straight lines. And these were originally developed to make life kind of easy, because in the old days, we marked this stuff by hand. So today we have computer programs that allow us to look at some really fancy things. But in the old days, before, we used these straight lines. And they still provide information. There's still a very simple, easy way to say, okay, what's going on in the marketplace and what's happening next. So prices rarely continue to move in a straight line. They're always kind of bouncing around. And so we have these trend lines that we try and use as to mark kind of the movement of grain. We're kind of looking over a time period. We're trying to look at how far do those trend lines extend. I'll show you some graphics in just a minute to explain this. What we're really trying to identify in most all of these cases is not only what is the general price movement, but when is that price movement shifting? When we have an upward movement in prices, when do we expect that price movement to start to tip over and change to a downward moving prices? And the reason this becomes important, of course, is because if I'm a farmer and I see an upward moving prices, okay, well, what I'm going to do is I'm going to hold until I think price movement has shifted and will start to come down. Again, it's this buy low, sell high trend line. Now, we can also have the same information if you're a buyer of cash grain. Let's say you're a livestock producer and you're looking at prices moving lower. Well, when should I try and purchase more grain for my feed supplies? Well, I'm going to wait until that bottom is formed, until that prices look like they're going to shift and move back upwards. And those might be a pricing point that I'd like to try and make some additional purchases. So trend lines are relatively simple. An uptrend remains intact as long as each successive pullback is higher than the previous one. For a downtrend, the same thing happens when prices are generally moving lower, but they're bouncing around. So each progressive high is a little bit lower than the previous high. So let's look at a graphic. This is much easier to try and show in a graphical sense than trying to explain verbally. So again, this is November soybean futures. This is an uptrend. Now notice this is again for November delivery for 2021. This is for pricing new crop. We can start looking at what we're doing for an uptrend is we're trying to pick these lows. So each of these successive lows, as prices, the general trend movement is upwards, but we're drawing a line based on each successive low. So prices go up and then they fall back a little bit. Prices go up and they fall back a little bit. And what we're looking for is at points like this point right here, where we see the current prices fall below that trend line. So we have a longer term trend that's been going on for a significant amount of time, basically since May. But we have a shorter term trend that's been basically going on since harvest. And it's this harvest one that I'm going to focus on right now. So we draw the line. What we're trying to do is play connected dots with each one of these pullback in prices. So in general, prices are going higher, but we see these pullbacks. When those pullbacks happen, where do they stop? So we're trying to play connected dots with all of those successive lows. And notice now, each time that those pullbacks come back and touch this trend line, it adds strength to the trend line. So all we need to do draw a trend line is 2 points. Okay, but each time we draw this trend line and the price pullbacks to that trend line and goes higher, pulls back and goes higher, it adds strength or reinforces our viewpoint that prices will continue higher. So what we're looking for as a price turnaround is when today's prices fall below that trend line and they continue going lower. So we did have 2 days in here where we broke, where the current prices fell below that trend line, but then they rebounded. So if we were looking just at this information here, I'd say, well, wait a minute, it looks like that price momentum upward has shifted. Something happened in the marketplace. We don't know what, we really don't care what. It's just something happened in the market psychology, their belief about what the future is going to bring, this caused prices to go lower. Now, it was only for 2 days, but then it continued to extend. So this upward trending line, again, this is as of the close of Friday, is still intact. Even though we did break it back here, we brought reinforcement back into this trend line that it has some strength. So if we look at a very general sense, the momentum is still higher. Even though we've had a lot of bouncing around, we've had higher prices, we've had some lower prices, this trend line is still intact. So that's an uptrend. I did put an uptrend for wheat because the reason I'm showing this graphic for wheat is that the same basic principles apply, but I'm going to show a downtrend. And guys, I had a really hard time finding a downtrend in soybeans. So I had to shift over to wheat and wheat futures to try and demonstrate a recent downtrend. So the uptrend, again, is we're looking at these when prices go up and they fall back, when they go up and fall back. Over here, if you notice in the wheat market, we did have a break in this price trend. We had a new trend, upward trend start to develop, but it was also broken. So when prices start falling below and they stay consistently below, that trend line now is thrown out because that uptrend is broken. We're looking at more of a sideways pattern in the wheat futures. On the downtrend standpoint, so how do you draw a downtrend? Instead of picking the lows, you're picking the highs. So we're looking at these, when prices come up, they hit an upper level and then they fall backwards. And every time they hit that higher level, that price spike, it comes at a lower level than we've seen before. So here's a downward trend, an example of a downtrend. It was broken here, so we can forget about that one. We had a new downtrend start to appear back here in November, December. That was broken. We went higher. We have another downtrend in the wheat market. Now, this is Chicago wheat, not Minneapolis spring wheat. We had another downtrend starting to form here. So that downtrend will be intact. It will be a kind of influencing our expectations for the future until we start to see today's prices, represented by the blue bars, break through and push higher above that trend line. So the general trend line right now in Chicago wheat is lower, but the general trend line in November soybeans is higher. Okay, let's talk about support and resistance levels. Again, what we're looking for here is where we've seen an upward trend in prices, where we saw kind of a stopping point and a reversal, where prices were going up and they started coming down after that pricing point, or on the flip side, where prices have fallen to a kind of a key mental trigger point and have started to rebound. So the support and resistance levels we're looking for where price movement historically in the past have flipped, where prices have gone up higher and then suddenly came lower, or prices have fallen down and started and stopped. So think about it this way: a support and resistance level is, as, let's say, assuming prices are going higher. As prices go higher, what happens to the volume of selling? Not only the number of sellers, but the volume of selling, it starts to increase, right? But what happens to the number of buyers? As prices go higher and higher, the number of buyers and the volumes being purchased start to decrease. So that trend line tips over when the number of sellers outweighs the number of buyers. Just the same as on the reverse side, as prices are falling, the number of buyers and the volumes being bought start to increase, and the number of sellers, the volumes being sold, start to decrease. And so at what point do the number of of now buyers start to outweigh the number of sellers. Well, that becomes that turning point in prices, or what we call a key reversal. So let's start again. This is November 2021 soybeans. So let's look at some key pricing points where prices where it's support levels, where prices have fallen, stopped falling, and then formed a recovery. And what we look at is those become some psychological barriers. So if we see a pullback or a retracement, a falling of prices, how low will that go before we start to see these key changes where psychologically the market says, oh, wait a minute, prices have fallen enough. The buyers start to say, hey, this is a value buy, and prices start to increase again. And what we're looking for is these key changes, these key shifts. So on the support side, we're looking for where prices have fallen down and then began to recover. So we have a key support level at about 1096. We have one at about 1021. We have a one at about 938. Now notice these numbers fall very close to a number ending in a 5 or a 0. And that becomes a psychological barrier. So let me ask you a question. You don't have to answer it. But if you were to pick a pricing point to say, at what price would I be willing to sell more grain? Would I be willing to sell more soybeans? What price would you pick? And I want you to pick a specific number. My guess is you're going to pick a number that ends in a 5 or a 0. It's a nice round number. It's human nature. We tend to pick those points that end in a nice round even number. So 1096, very close to the 1095. 1021, very close to 1020. So we have these psychological barriers as a buyer. At what price level would I be willing to purchase more? What price level would I say, ooh, here's a great opportunity to be able to buy and lock in a price? Or on the flip side, if you're a seller, okay, at what price would I be willing to sell more as a farmer? Well, as prices are going higher, I pick these pricing points, and those then become the psychological barriers. So the support level is when prices have been falling. The resistance level is when prices have been going up. And again, notice these tend to fall very close to something that ends in a 0 or a 5. Now, there's an exception right here at 1203, 1204, but 1266, very close to the 1265 mark. You come down here at 1061, very close to the 1060 mark. So on the resistance side, what we're looking at is for those price spikes. At what point would we see a spike in prices where the number of sellers started outweighing the number of buyers? Okay, now, if we put these together, where we have support and resistance together, each one of these becomes an important pricing point. So now what we've seen is prices have risen to about 1265, where it looks like prices are starting to drift lower. At what point, where's the next psychological barrier where all of a sudden prices start to fall to a point where it looks like, again, from a buyer's perspective, this might be another opportunity to jump in and make some additional purchases, where all of a sudden the number of buyers start to outweigh the number of sellers. So we look for these pricing points, either on the upward trend or the downward trend. So right now, we've seen this downward trend start to form. All right, well, how low will it go before we start to see prices rebound? The first test, the first psychological test, will be at about this 1203 mark, because that's where we spiked before. So when prices move through that resistance level, it now becomes a support level. Now, if we had a lot of negative news in the marketplace and prices continue to fall, psychologically, the next major break point would probably be at this 1095 mark, because that's where we dropped lower and began to rebuild from there. So that becomes our next psychological barrier. I'm going to skip over volume and open interest. Again, if you want to go through this or if you have questions, I'd be happy to answer them. But for the sake of time, there's some other indicators that I want to get to that probably will be more useful for you as marketers to try and set some pricing objectives, some pricing standpoints. So I'm just going to go through and we're going to move on to stochastics. So the term stochastics really means movement. It's changing. So now we're going to go from these these static trend lines or those support and resistance levels, which by the way still work and work pretty effectively, to what we call the stochastic. So let's look at price movement or price momentum, and how can we use this price momentum to set some new expectations or set some realistic expectations about how high prices will go, or how fast prices may fall. So a very simple one is a moving average. And again, the moving averages are very simple. So very common moving average, we have a 5-day, a 10-day, a 20-day, 50-day, 90-day moving averages. So all we're looking at is we're going back in time. We're using the closing price, the price at the close. And the idea behind using the closing price is that that closing price, captures all of the information available during that trading period. So if we got new information during the middle of trading, that would be incorporated into our expectations about the future, and we captured in that closing price. So a moving average, all we're simply doing is we're taking, for example, if it's a 10-day moving average, we look back the last 10 days, we take the closing prices, we add them all up, divide by 10, we come up with a new number. And tomorrow what happens is we add a day, we subtract a day. Now, I want to emphasize the reason we're using a 5, 10, 20 is because we tend to have 5 trading days in a week. So a 5-day moving average reflects really the average for a week's worth of trading. A 10-day moving average reflects the average for the last 2 weeks of trading. A 20-day moving average will be the average for the last month. Now, depending upon, which contract and your kind of which math you wanted to use, sometimes they'll use a 40-day or a 50-day, which really reflects 2 months. Sometimes they'll use a 90-day or a 100-day moving average, which is supposed to reflect 3 months of trading. So we're looking at where did today's market prices fall relative to a week's average, 2 weeks average, a month average, 2 months average, or a 3-month average. So what happens is we're saying, well, those moving averages now become another way of thinking about support and resistance levels. Okay, so instead of using a straight line as the support or resistance, we're going to use this moving average as saying, well, what would be typical for this time period, and how do today's compare to this historical average? So a short-term moving average, when that starts crossing a longer-term moving average, we look at that as a psychological shift. So let me show you a graphic and show you what I'm talking about. In this graphic, we're using a 5, 10, and 15-day moving average. So we're using a 1 week, 2 week, and 3 week average. So the blue line is 1 week, the red line is 2 weeks, and the purple line is 3 weeks. The way we use this information, an uptrend is during this kind of time period where today's prices are above the 5-day moving average, and every day it kind of falls down and touches that 5-day moving average. So it's like, well, okay, we have a pretty strong uptrend forming or working. Well, now when we see today's prices fall below the 5-day moving average, that's kind of our first support level. Okay, so that's a short-term adjustment, saying, well, okay, short-term, something happened where our expectations about the future adjusted relative to where we were about a week ago. Now, when today's prices continue to fall and fall below that 10-day or 15-day, now we're saying, wait a minute, something happened. Our expectations about the future really shifted. So we not only look at what today's prices are doing compared to these moving averages, think about them as, again, a support and resistance, but we also start to look, well, when the blue line starts to cross the red line, that's another indicator. It's another reinforcement that we're probably moving into a downward moving market. When we see the red line, which is 10-day, cross the 15-day, it's a reinforcement. Yep, we might have some negative news in the marketplace where our view of the future has changed. So we're using those as kind of indicators. Now, a lot of times, what we like to say is the days of moving average really reflect our planning horizon. So if we're a very short-term trader and we're looking at a a kind of a trading, what's going to happen in the next week or 2 weeks or 3 weeks, we can use these 5 or 10 or 15-day averages. So the general rule of thumb, the general guidance is, well, if we're trying to forecast forward and look into the crystal ball forward, we should take about that same time period backwards. So if our planning horizon for making a decision is in the next week or two, we should only look back about a week or two for our averages or for our reference points. If our thought process is, boy, I need to make some additional sales in the next month, so our planning horizon is about a month forward, we should look about a month backward as that reference point. Okay, well, a month backward would be 20 days. A month forward would be, again, 20 days. So the techniques that we're using and the time frame we're using for our reference points should really match what our planning horizon is. So let's look at a longer planning horizon. As farmers, a lot of times you're thinking, well, I've got a few more, I haven't even planted my 2021 crop yet. If this is November futures, what do I think is going to happen in, let's say, the next month versus the next 2 months or the next 3 months? What would be some pricing targets I could use, and where do we look at possible support and resistance levels? So now I changed the time frame. The blue line represents 20-day moving average, the red line a 40-day moving average, and the purple line a 90-day moving average. So when we look at today's prices or the close as of Friday, we say, yeah, it looks like we're getting a softening in prices, but we haven't started touching this 20-day moving average. So if I'm looking at doing some pricing in the next 20 days, we're still in an upward trending market. We haven't broken that 20-day moving average trend line. Now, today, if we start to see today's trading or trading in the next couple of days continue to push lower, we're looking at saying, well, boy, this based on my planning horizon of the next month, maybe I should be looking at locking in some prices today because it looks like a downward trend is starting to form. Okay. Let's look at some other indicators. So what I like to say is that the indicators I'm talking about, the tools I'm talking about, are really like the gauges on a dashboard, like the dashboard of your combine or the dashboard of your tractor or the dashboard of your car. You have a lot of different indicators, a lot of different gauges telling you different things about what's happening with your car or with your tractor or with your combine. So think of each of one of these techniques as a different gauge. Okay, so if we have, and it's giving a little bit different representation about what's happening in the marketplace. So we have some of these indicators are very sensitive. They're very short-term oriented. Think of those as like your speedometer on your car, right? It doesn't take much of a change in your movement, in your, how hard you're hitting the gas to have a change in that speedometer. And watching the speedometer is important because obviously you don't want to speed too much and have a ticket. But it's a really sensitive gauge. It bounces around, it changes very quickly. And we have other indicators, both in the marketplace as well as on your dashboard, that are slower moving. For example, your gas gauge. Okay. Now the gas gauge doesn't change very quickly, but when it starts to get into a critical zone, boy, you better be paying attention to it, because if it starts getting close to zero or empty, the gas gauge suddenly becomes a lot more important than the speedometer. And you need to pull off and find some gas pretty quickly. The same can be said for the gauges on your combine, right? Your rotor speed, how much grain is being thrown over the sieves, how fast you're traveling forward, what is the yield monitor telling me? So each of these different gauges are telling me different things about what's happening internal, and I need to monitor all of them. If we start to see multiple gauges telling us kind of some similar things, we better pay attention to what's going on. The same can be said for these indicators for the technical analysis. A single indicator may not give us the full picture of what's happening in the marketplace. But if we start to see multiple indicators telling us the same kind of story, now we have to really pay attention and say, boy, maybe we should be thinking about doing something from a pricing standpoint. So what are some of the other indicators we can look at? Well, I'm going to go through Bollinger Bands, RSI, which is Relative Strength Index, and the MACD, which is the Moving Average Convergence Divergence. So these are three very common ones I've seen used by professional traders. They're talked a lot about in by different analysts. So if you subscribe to a private analyst or for example, Pro Farmer, or if you have a consultant you've hired, they may be talking about these different indicators. They're saying, oh, well, the MACD is doing this, and so that has this implication. I'm going to make a recommendation that you do X. Or I make a recommendation, we're going to wait a little bit because certain indicators are telling us certain patterns. So I just want to go through, I'm not going to go through the math on it. I do give that as a description, but I do want to go through how do you use this information. So let's start with the Bollinger Bands. This first set of discussion, it just talks about how is it calculated. I really don't want to go through the math on it, but I will describe what it means. So the Bollinger Band, again, we're picking a time period. In this case, it's a 20-day time period. So we're looking back the last 20 days, which means that we can use this as a pretty good indicator about what we think might happen over the next 20 years or 20 months, 20 days into the future. So the blue line that runs through the middle is that 20-day moving average. So we'll take the last 20 days, we add a day, we subtract a day as we move forward in time. So we're using that as kind of the midpoint. Now we also take a standard deviation. So a standard deviation is just the math behind how variable is the marketplace. So think about that standard deviation as what would be a typical range. So we're taking the blue line, which is the average, and we're adding 2 standard deviations and subtracting 2 standard deviations. All that means is we're looking at what would be a typical range based on history. What would be a typical range of prices we would expect to see? And so the upper red line and the lower red line is, we're saying about 95% of the time we expect prices to be in that range based on history, historical variability. Well, the way we use this information is say, well, if today's prices, those black lines, are above, if we're in the top half, we're above average. Based on the last 20 days, we're above average prices. And if we start to see today's prices touching that red line, it means we have a very strong upward movement. We have a very, very rapid upward movement in prices. If we start to see these prices touching the bottom line, the bottom part of the red, we're in a downtrend, and it's looking like, well, wait a minute, we might have some pretty heavy downward movement. So if the prices are in the top half, if we're above average for the last 20 days, we're still in this upward moving market. We're looking at higher prices. We're just saying, how aggressively are we moving upwards? Well, based on what we saw on Friday, we're still in this upward trend, but it looks like that upward trend may be weakening. We're still above average based on the last 20 days, but it looks like that might be slowing. So again, we can use this as an indicator. We might be seeing a top, a kind of a topping over the next couple of days forming. So if this black bars fall below the blue line, it's an indicator that, yep, we're starting to move from above average prices to below average prices. So the question is, how far will they fall? Well, we're going to use this red line as the next indicator. So the first is the blue line as an indicator of support or resistance, depending upon if we're moving upwards or downwards. And then the red line becomes that kind of typical or average range. All right, next we're going to go to RSI, Relative Strength Index. This just shows the math behind it. So let's look at the bottom line, the bottom bars down here. So what we're looking at is this Relative Strength Index is a ratio. It's a ratio of the days that went up and how quickly they went up versus the days that went down or how quickly it went down. So again, we're looking back in time. We're picking a time period and saying, given this time period, how many days did it go up versus how many days did it go down? And we're looking at that ratio. So if the ratio is 50-50, it means over the last history, the time period, and this is a time period of 24 trading days, how many of the last 24, how many went up versus down? If it's 50-50, we've got the same upward movement as we have downward movement. Now notice we also have these lighter red lines. So we've got the ratio, which moves around, and every day we recalculate that. And we have these kind of trigger points. Now, this RSI is a slower moving average. So think of this as more like the fuel gauge. It doesn't change very quickly, but boy, when it does change, when we get to these critical levels, either on the high side or on the low side, gives us some information that, wait a minute, the market might be reaching an upper point or a lower point. So if we look back over time, it's very rare. Notice going back into the early 2020, it's very rare for this ratio to either get above 80 or below 20. Now it did happen. It touched it a couple times back here. We saw it touching back here in March. We actually broke through it and went above 80 a couple times, both in November as well as January. And notice there's a very strong correlation between what's happening here and what's happening in prices up here, which makes sense because we're using the information in the black to calculate what's going on in the red. So when we look at this, we think about this as an indicator of price momentum. Okay, and it's very difficult for the markets, for the futures market in particular, to start getting above this 80 point and staying above this ratio of 80 very long. Same on the downside. When prices are falling, it's very difficult, very unusual for prices to fall so rapidly that it hits this 20 mark. So anytime that we see this ratio reach near 20 or 80 or above, it's an indicator that we've got to pay attention. So if it looks like it's an 80, it means that we've had a very strong upward movement over the last month or so, and that upward movement, it's going to be very difficult for that upward movement to carry its momentum. Right now we're at 66, but it looks like it's downward trending just a little bit. So we look at the direction, look at the value, but we also look at the direction. So this is an indicator saying that we've reached a kind of a temporary high point. It looks like that indicator might be moving lower. So again, we're adding reinforcement to the idea that we've had some very strong prices. Those prices may look like they're weakening or softening a little bit. The last one I want to talk about, and I know I'm going to run a little bit short of time here. I apologize to Dr. Wilson, is the MACD. So let's just look at this, another indicator. So we're looking at moving averages. The blue line and the purple line, notice right here, are moving averages, and we're looking at those moving average crosses. So we have a short term and a long term. I really want to do is focus on these red bars. That's really what I want to focus on. So if you notice, the red bars represent the distance, the difference between the blue line and the purple line. Notice there's a price correlation here between prices moving upwards and downwards versus what's happening with those the red bars. What this indicates is it's not only indicating the price movement, are we moving higher or lower, are we above the line or below the line, but also is an indicator of momentum. So what this is indicating here in this red range right here is that prices are moving higher, and as that bar gets bigger, it means the momentum is increasing. So prices are moving higher and moving higher more rapidly. When it looks like, when it starts to break the bottom, it's saying that prices are moving lower, and the height of the bar represents how quickly are we moving downwards. So notice that we're measuring the distance between the blue line and the purple line, and we're looking for direction and movement. What it's signaling right now, as of Friday, is that the short term is starting to cross long term, which indicates that, again, we will likely be moving into a downward moving momentum. The question is, how fast will we move downward? So now we have three indicators. We have the Bollinger Band, we have the RSI, as well as the MACD, all telling us that it looks like we temporarily formed a topping, a high in the marketplace, and with the momentum is probably shifting lower as we move forward in time. So we can use this information to say, well, is now a good time to try and do some additional pricing for my 2021 soybeans? So with that, I'll pause. We'll take some time, a couple of minutes here for questions, and then I'll let Dr. Wilson jump in on his section on basis.
Any questions for Frayne? Oh, I see one just popped up.
I know that this is a lot of information to absorb. That's why we're recording it. That's why we'd like to go through this. And again, if there are any questions, I'll be happy to answer them.
So we have a question about which charting website that you would recommend.
Okay, so, and I've got to be really careful about this because I'm trying to be as neutral as possible, but the one that I have found to be very useful and accurate is Bar Chart. No, not with an S. There's another company called Bar Charts with an S, but the one I like to use, I use the app. I also use it, and in fact, let me share my screen with you quickly. I'm just going to pull over. This is a picture of Bar Chart, and I pulled up the November futures. Guys, you don't have to have really expensive, sophisticated software. You can pay for additional service if you wish, but this free program, you just log in. You don't have to log in, just subscribe to it. It's free. It has all of the studies, which is like the Bollinger Bands and the RSIs that I just showed you, as well as the basic tools for being able to draw in trend lines, horizontal trends. They have a lot of different kinds of techniques that you can choose. It's all free. It's very simple to use. This is the one that if I were to choose one, this is the one that I would try and recommend informally, of course. There are others out there. I know DTN has some really nice charting techniques and charting tools that you can subscribe to. But this is one that's free that I like to use for easy demonstration.
Any other questions for Frayne? Keep an eye on the chat and the Q&A function here. I did share the website for Bar Chart in the chat.
Thank you.
Yes. Otherwise, I think with no other questions, we are ready to move to Dr. Bill Wilson. Bill.
Okay, and I'll hang on for a little while,
yes.
and if there are some questions at the end, we can certainly talk about those.
Great.
Thank you.
Thanks, Frayne. Bill, are you there? He might have stepped away when he thought we were going over on time. Oh, I see you're off mute.
Okay.
All right, we are ready for Dr. Bill Wilson. He's going to cover basis behavior.
I'll share my screen, Jenna. You confirm if it shows up okay.
All right. We can see it, but it's not in presenter view.
Okay, how do I do that?
If you click on, I don't see the little icon. If you go to slideshow at the top ribbon there.
On my PowerPoint?
Yep. If you click that and then from beginning.
Yep.
If you click that and then try to advance the slide so I can make sure that's happening. Yep, you're good to go.
Okay, thank you.
You're welcome.
I apologize to the audience, but nowadays at the university, we speak on about 5 different media per day. So typically, so it's good Jenna's here to help us out. So I'm going to speak on the topic of bases. These are the topics I'm going to speak to. I got a pretty big slide deck, so I'll just pass on. Let me just say at the outset, we are probably in pretty much uncharted territories today in the case of many world commodities, but particularly soybeans. And as smart as we probably think we are, we don't have much experience doing what's going on in today's market, whether it be at the futures level or in the basis market. So best we can do is give you a little perspective as to what we think will be happening. Let me share to you a slide I use a lot, and it's to complement what Frayne talked about. This shows a relationship on the horizontal axis of the stock use ratio to the vertical axis, which is the futures price. Now that's the crop year average futures price. And this is the customary way that most commodity analysts analyze markets in one way or the other. You'll see on the far right-hand side in 18 and 05 and 06, with very large stock use ratios, and future prices were very low. And as we go leftwardsly, you'll see in 2013, we had a stock use ratio of 3.2%. That resulted in a crop year futures price of $14. So today, Frayne said we're at 2.6% in his numbers. nobody knows how close we are going to be to zero, but we're real close to zero. But the point I want to make is, though the average for the crop year would suggest maybe that means like 14 or slightly above 14, we have very little experience out there. It could easily range upwards of 15 or 16. That would be doubtful for a crop year average, but we have very little experience out in that range. So I put in the bottom here, I was using a stock use ratio of 3.3. Last year it was 0.025. And so we're very, very tight stock use ratio. In that crop year 13-14, Frayne cited earlier, the seasonal high was at 1536 in May 22nd, and it fell $2 a bushel inside of a couple of weeks. That's how volatile of markets we are in this situation. So here's the current markets I'm looking at. In the top shows, I use the MACD Frayne referred to earlier. Actually, the reason I use that in Bloomberg in our trading room, they have a back testing algorithm. And every year in my class, we test to see what is the single best technical tool. And just about always, it ends up being the MACD. So that's what we use. Top chart shows the futures prices for May. You can see it's bottoming out now and trying to grab a little upside momentum. The bottom chart shows November, which has clear upside momentum. And the bottom chart is the inversion in the market. And I'm going to speak to that later. Someone raised a question about that, and it's a very important topic, so I'll speak to that in detail in a moment. So when I speak about the bases and the markets, I'm specifically talking about the bases, which is cash minus futures. Remember when I first started teaching, we probably spent 95% of our time on the futures markets. And now in today's marketplace, we really got futures, options, rail markets, and cash markets all operating at one time and all being somewhat related to each other. So we spend probably as much time now on rail markets and cash markets as we do on futures. And Dr. Bullock will speak tomorrow on options. So probably the most important factors impacting bases are shipping costs, storage costs, and premiums and discounts. And I'll speak to the first two of them for purposes today. So this is the normal behavior of the bases that we expect to occur. This is time on the horizontal axis, and the vertical axis is the basis value. And the idea is that the basis is very low at harvest and then increases at a kind of constant rate throughout the marketing season. And then on the right-hand side, I say basis equals DC. That stands for delivery charge at the delivery market. And what that means is during the delivery month, arbitrage pressures will force the basis to equal that delivery charge. Now you'll notice that black line, technically that would be the reduced cost of storage as we get closer to the delivery option month. Now the blue line is my line, and after many years of teaching this for commodities in this part of the country, it's just about always the case that harvest time, we have extremely depressed basis values, shown by that downwardly adjustment in the blue line. And then in the post-harvest period, the basis increases at a faster rate than the reduced cost of storage. Now, in concept, what goes on, we're harvesting 5 or 6 crops at once. Things are going to go into storage. So farmers are going to sell until the basis falls real hard. Then it starts accumulated in storage. Then the basis got to appreciate sharply to attract it out of storage. This is as true in soybeans as any other crop, if not more true. And in fact, the average post-harvest basis increase in soybeans in recent years is $1 a bushel. That's a huge deal, and it has very important impact for farmer marketing. So you asked earlier about inverted markets, normal markets. This is my kind of go-to slide on that. On the left-hand side, it would be depictive of a normal market where there's a positive carrying charge. And the purpose of that is to induce or provide an incentive to store. On the right-hand side, we have an inverted market, which has got a negative intermonth price spread or a negative incentive to store. And probably the way I want to explain it to you is in the following graphs. This is from my class, but this is our theory behind it. And this is really the theory behind the supply and demand for storage. But that line moving upwards to the right is called the supply of storage. and those lines going down horizontal, going downwards are the demand for storage. The vertical axis is the price of storage. Horizontal axis is the stocks or stock use ratio. Now, the equilibrium of the intersection of those two represents an equilibrium. So in that middle set of demand, the equilibrium price of storage would be R, and that'd be a normal market with a positive price of storage, trying to induce you to store the commodity. But under some situations, that demand function can shift far leftwards and have an intersection like you see there where the equilibrium price of storage is Q, and that could be a negative price of storage or what we call an inverted market. The intention is to discourage you from storing your commodity. I always tell my university class, when I teach you anything in this class, if you don't know spreadsheets, don't know anything else, if you're an inverted market, don't store. And that's pure and simple from a farmer perspective. Now, this particular year, what's happened in the past 2 years, we've went from a demand function for storage on the far right-hand side that have very wide prices of storage, a very large amount stored, and that demand function for short has been shifting leftwards and leftwards until it eventually became negative. And at a stock use ratio of 0.03 in that area, we have a large inverted market. So that's shown in this spreadsheet. This is actually from my university class. And I encourage students, this is an assignment actually in their class. And on the far left-hand side is the futures prices. And you'll see there that the nearby is a premium relative to the deferred. The basis there is the expected basis. Now the basis we use in my classes for Kensal, North Dakota, just nearby Jamestown. And so that results in a cash price and a spread. And you see that spread is always negative. So what is the optimal month to store to? The answer is don't store at all. If we build in storage costs, put in some if statements, on the far right-hand side, we get our net prices. Net return is $13.50 in the nearby, and every month thereafter is lesser. So there's no incentive to store the commodity. Hedged or unhedged, don't store the commodity. Okay, so here's the price of storage between May and November in the soybean market right now. Now, what's interesting, if we went back to the end of September on the far left-hand side of that graph, it was about 40 under. So it was a negative price of storage, but not too bad, 40 cents, minus 40 cents. And then over time, it fell, and eventually went down to minus 240. Well, what that represents is a leftwardly shift in that demand function for storage in response to probably the improved at that time through early January growing conditions in South America. Since then, as you all know, growing conditions have deteriorated. I read a crop report the other day from a very knowledgeable analyst, and he said we will need to expand as much as possible and have perfect crop conditions for this to reverse. So you can see on the right-hand side here that the price of storage has been increased. In fact, it's narrowed from minus 240 to minus 175. So it's narrowed by 70 cents in the past 2 months, which is a very drastic change in that price of storage. Nevertheless, it's still negative. It says don't store old crop and be looking at new crop only. So the other feature that we have to talk about is rail rates, and I'll just make a few comments on this. I've worked a lot on this in my career and continue to, and because of our rail pricing mechanism we have in this country now, we have a secondary rail car market, which has an influence on basis values at origin and at destination. And in the top chart here shows a history going back to 2004. You'll see that it's typically close to zero. On average, it's about $250 a car, but periodically it spikes up to $3,000 or $4,000 or $5,000 a car. And when that occurs, we have delayed car placement, which has an impact on the local basis values, which I'll articulate to you. Now, this secondary market is not exactly like a futures market, but I can tell you I had worked on the development of this, and we had considered putting it on a futures market, or the railroad did, but they chose not to because they did not want to allow speculators to dominate that market. Kind of interesting. So the idea is that the railroads auction off rail equipment. I call that the primary market. And then grain companies buy that rail equipment for 12, 24, or 36 months forward. And then the grain companies, they can, if they don't need it, they can sell it. Either they can offer to their buyers as part of a procurement strategy, they can sell it through a brokerage company, or they can use it themselves. So that is what brings about this secondary market. So I'll elaborate a little bit on that. Here shows an example of what would be the primary market. This is from a few years ago, but it's the same today. So in the upper part, it says BNSF Railway Shuttle. They're going to auction off one shuttle train for last period in October. That's what they're doing. And then by 2 o'clock or 3 o'clock that afternoon, everybody submits a bid electronically. Used to be done by fax. And on the lower part of this, you'll see that they received a total of 7 bids ranging from $1 to $77,000. And the highest bidder won it is $77,373. So then that company ends up owning that train for that month. And then they could use it themselves. They could sell it. They could use it, provide it to a supplier as part of a procurement arrangement, whatever they have. So there's a couple secondary markets that are very dominant in this area. One is Trade West, and this is their price sheet that they put out just last week when I put these notes together. It's not a perfect market like a futures market, but it shows a bid and an ask for different periods forward. So you'll see in the nearby, the bids are about $350 a car. And as you go into May, I'll use my cursor here if that helps you see it. It goes into about minus 150 car. In June, there's no bids, but someone's offering minus 250 car. It's saying, I will buy your cars if you give me $250 a car. What that means is I will take your obligation to ship, but you pay me $250 a car. Now that number is pretty interesting because the cancellation penalty for a shipper is $200 a car. So they got to evaluate, should I cancel the car for the rest of my contract period, or should I sell this particular month for $250 a car? Now it's pretty interesting that it's very weak here in June and July, and it isn't until we get out here till the last part of September, early October, where the bid and ask is 500 to 1,000. That's a pretty wide spread. October is $600 a car. Normally, the average in October is $800 a car. Now, there's another company in South Dakota named Malsum, and they put up bid and ask the same way as a brokerage company. And their numbers are represented very similarly. But I want to caution you, these are not the same. If you go back and look at my PowerPoint, they are different, and they're different all the time. I don't think one's better, different all the time more than the other, but they differ. So when people talk about the secondary car market, it matters where the bids or the offers come from. But you'll see in his here, as he gets out into October, someone's bidding to buy at $800 a car. That's for first half October. So I'm going to show you a bunch of charts here. These are partly things I've been doing for many, many years, but they want to show a bit of the history of the basis values at the origin, destination, and secondary car market. So here is the basis value at the Pacific Northwest. You'll see that we peaked out here a few weeks ago. This would have been in about last part of November, and since then have fallen about 50 cents a bushel. You can see in the bottom part, which is Jamestown, we fell commencing at about that same point in time. Now this chart shows the daily car value, the blue line, and the velocity of the rail shipments, which is this amber colored line. That velocity is the number of trip turns per month that the railroad gets. And that is one of the most important determinants of the value of the secondary car market. You'll see here that in periods where velocity goes low, like I'm showing right here in 16, it went from about 3.2 to just about 2. The secondary car market went from 0 up to $4,000 a car. What that really meant is a shipper was shipping expecting they'd have a velocity of 3, but they only had a velocity of 2, so they needed to buy grain in the secondary market. And that's what really causes that spike. So you'll see those spikes periodically in this data. Here I've added in the Pacific Northwest basis value, which is this blue line, and you can see how correlated this blue line is to the secondary car market value. Secondary car markets go up, and then the basis goes up. So it's really crucial here for you, and that's what I'm pointing to right here. The correlation between the secondary car market value and the P&W basis is 0.5. So they're positively correlated. The correlation to the basis in Jamestown is minus 0.19. So if secondary car markets go up, the basis of P&W goes up and the basis of Jamestown goes down, and vice versa. So it's not completely absorbed by the interior basis, nor the export basis is shared in a sense. So USDA recently come out with a dashboard, and this is the website for it, and it's very, very well done. And they publish these secondary car market bids. This is a big deal because USDA, this is part of AMS, their goal is to improve market transparency. So everybody knows about it, whether they're me or students in my class or you as participants in our program, know what that secondary market value is. Now, these are monthly averages, so they differ quite a bit from what I showed you earlier, which were weekly observations. Here's the seasonal average of the secondary car market. You'll see here that, and this is pretty important for you, September and October is very low, and then it increases and peaks out in about January, and then declines. And this is what we're going through right now. This is where we are right now. Then it increases again in the post-harvest period. So it's very seasonal, but you look at how these two blue and black lines represent the standard deviation, represent how much it differs from the mean. So in February, there's a huge amount of uncertainty, if you like, in the market. Well, that directly coincides with the end of old crop farmers selling in the United States and the beginning of new crop farmers selling in Brazil. So this is a summary of this primary and secondary market. I don't think it's necessary that I elaborate on it unless somebody wants me to in the Q&A, but what's important here is the average secondary market value is about $225 a car. In the primary market, its average is about $54 a car. All right, so let's talk about the current market. And I'm going to speak about, firstly, spatial competition, Pacific Northwest and St. Louis, and then the basis values in Brazil, Pacific Northwest, US Gulf, and North Dakota. And then I'll come back and give you some ideas about the future. So, you know, we use, Frayne asked, what do we use? In our trading room, we use DTN, MyDTN, Thomson Reuters, Bloomberg, AgriSenses, and some other sources. Probably the best free site for this type of information is called mydtn.com. It's a free site we use in my class. I'll show you some slides off of that. But in addition, you know, in this world, even though you think you got all the information that exists, you can always get more and get better information. One of the sources I use is that from ADM. This is their ADM bid sheets from last week. They're a supporter in our trading room. They're one of the biggest buyers in the country and world. So I use them to get a grasp of these. So these are their values for shuttle trains delivered P&W. You'll see for May going forward at 153. And for St. Louis, 35, 44, and 28. And I'm going to talk about the significance of that difference here in just a moment. But graphically, so you can see how these look. This is the P&W basis from 2018 until current. You'll see back here in September 19, it went down to a low of plus 15. And then this year in November, we went down to about plus 75. And then recently went up to about plus 85. Now, I got to cautious, this is track delivered. That is different than FOB ship. And frequently you're going to see them mixed up a little bit. Here's the basis at St. Louis. And I point out St. Louis because it's a logical easterly market for soybeans grown in North Dakota. That'd be shuttle trains to St. Louis, transloaded to a barge, then move down the river in a 12-month barge open season. So you'll see here back in 2020, March, September, we were pushing about plus 20. We crashed here in early November, coincided with harvest. And since then, we've increased to about plus 35. So if you want to compare the returns, and this is important for you because frequently, as some of you know, I'm on the Soybean Council Board, and frequently say, well, why don't we ship to another market other than P&W? Here's the reason why. For current period prices, here's the track values at St. Louis and P&W, the freight cost to St. Louis and P&W, the bases that would be net from there. The current bids in Jamestown are 85 under. That gives a profit to the shipper at Jamestown of plus 82 cents going to the P&W and plus 20 cents going to St. Louis. And for new crop, the same exact conclusion. So just about always, P&W is going to be preferred. Well, in our calculations, I was still doing a thesis on this now, I think only about 15 or 20% of the time is it more profitable for a North Dakota handler to be going to St. Louis versus P&W. It's pretty simple. P&W is a strong basis market, and the railroads like moving soybeans to the P&W, so they'll always keep those values competitive. One of the dark horses in this marketplace of the bases is the role and impact of Brazil. We use a company by the name of Agribusiness for this data. About a year ago, Dr. Bullock and I did a study which is kind of monumental, but it showed that one of the most important variables impacting the bases in the Pacific Northwest, U.S. Gulf, and central North Dakota is the bases at Brazil. So understandably, they're a competitor and their basis goes up and down, our basis is going to go up and down. Here's the current period forward curve for Brazil, U.S. Gulf, and P&W. The green line is Brazil. Now their basis currently is a discount to futures. Get that. Now, until a few weeks ago, they were about 30 cents over. And then as their harvest accelerated, their basis fell very, very sharply. So they're like 5 under the futures. That's FOB ship. But look at how rapidly that increases between, this is M1, that's current period. As we go into, say, 5 months forward, that goes into July, August. So we go from -5 up to plus 120. Well, I can assure you, if Brazilian basis goes up that high, that's going to put upward pressure on the basis in our market. So this is the basis of the U.S. Gulf, and this is the basis of the P&W, which is not reported that far forward. Okay, so that's something we pay a lot of attention to. If you get real microscopic about the basis, that's pretty important. So if we talk about competition between U.S. and Brazil, on the lower part of this chart, I want to kind of zero in on this. This is the price delivered China in dollars per metric ton from the U.S. Gulf, P&W, and Brazil. For April shipment, Brazil has an advantage of about $45 a ton. So that's maybe $1.10 a bushel. And you can see that their advantage for all of those months going forward until really we get into September, their advantage is pretty substantial. And that September period really is the effect of that very radical increase in their basis value. So I suspect exports from the US, you saw on Frayne's chart and the chart Jenna sends around, have been falling very drastically in the past month or so. And I'm sure it's in response to this phenomena here. So there's a lot of variables that go into this calculation. But looking forward, we should not be looking to be very competitive in these markets except isolated instances until we get into that August, September period. So I'm going to show you a bunch of charts on the bases. I use Arthur and Air in the Pacific Northwest and Brazil, and I'll speak to each one of these. Then I'll come back and talk about the outlook looking forward. So at a high level, this shows the basis values in dollars per ton at Brazil, PNW, and US Gulf, in all cases delivered to China. So you can see that generally speaking, they're highly, highly, highly correlated with each other, excepting mid-2020 when our price was a lot cheaper. And now recently, our US Gulf price has been escalating relative to that of Brazil. So generally speaking, you take away the import tariff business and all this, is a very, very competitive market within plus or minus $5 a ton, which is not very much. So here's the seasonality of the basis in Brazil. I'm going to show you like charts for the other markets. So these on the left-hand side is the different crop years, and that bold red line is the average over those crop years. So you can see that it's seasonally low in Jan, Feb, March, and then after about May, June, it starts increasing. You can see some crop years it increases more, and some crop years it increases less. On the right-hand side shows the seasonal average. So we're real big on seasonal behavior of the bases. There's not very much seasonality in the futures, but there is significant seasonality in the bases. We've studied this a lot. If you'd like a study on us, let us know. But you'll see that their basis peaks out here in about July, August, just before the beginning of our new crop year, and then their basis falls. Here shows the bases at the US Gulf and PNW. The gray line is PNW. And obviously they're very correlated with each other, probably impacted a lot by ocean rates and ocean rate differentials. PNW generally is always a premium to the US Gulf because of that ocean rate and ocean rate differential. Here's the basis at the Pacific Northwest. And this red line in the same format as before is the average. You can see it's pretty solid around $1 a bushel until we go into August, September, when we're at the very end of our old crop where it pops up to about $1.40 or so and then falls. This current crop year, you can just barely see it, but we are just about exactly following that long-term historical average in the current crop year. So here shows the basis. This is from mydtn.com. And I believe this is free. You could check and tell me if I'm wrong. But this is a snapshot of the spatial basis from March 4th. So take a look here. We're predominantly here about 80 under in central North Dakota, maybe 85 under in the eastern part of North Dakota. You can see other states vary and they get closer to the river. Of course, the basis gets higher and higher. So we use this a lot in our research and in our university teaching. But keep that in mind, those numbers minus 80, because you'll see them pop up here again. So here's Air North Dakota. And I use MACD, and I'll tell you why in a few minutes. But predominantly what MACD is good at is it's a turning point. One of the problems with looking at trend lines and stuff like that is it's hard to detect very easily a turning point. But MACD is very clear in depicting a trading point. And this shows the basis in air from November 18 until current. And you can see here from going from about September-ish, we went from about minus 90 to just about minus 60. And in recent weeks, we've fallen off back to about minus 85. That is just about a picture-perfect seasonal behavior of the bases in this part of the country. And you can see we can plot out buy and sell signals that emanate from this MACD line. So we peaked out here in early November, early to mid-November. Just about always, I'll show you the basis peaks out in that time period. Here's the basis again for air. And you can see these are for the different crop years. So you can see a lot of variability across these. We have 2013-14, which is really, really high. We had this solid blue line here of 2019, where it's extremely low. This solid red line is the long-term average. So this line here, back right here, see where my cursor is, that's the current crop year. So what that says is we're currently stronger than average by about 20 or 30 cents a bushel. So we say the basis is stronger than normal by about 20 or 30 cents a bushel. Typically, we would bottom out in April, May, peak out in about July, fall down again into September, October, and then go up. Now, we've depicted it seems to me there may be a changing seasonal behavior, because I've been doing this for a lot of years for many different parts of the state. But I went back, and if we did this through 2019-20, also at Air and Arthur, you'll see that the basis peaks out on average in December. So we always say, and I'm guessing Frayne says this in his marketing programs, best strategy for North Dakota farmers, hedge on hedge, store at harvest, plan to sell in December. You can debate November until January, but December is generally the best month to plant it. And it's based upon this fact. Now, as I showed you in the earlier slide, because of when we include the most recent crop years, we end up with a higher basis in July, which may suggest we're having a change in seasonal behavior of the basis. And I have a feeling that the basis in the past couple of years has been more top heavy during July, which might have shifted that basis upwards. Okay, so here's that current most recent 6-year average basis in Arthur. You can see it peaks out here in July. Again, I think that's due to the recent couple of years behavior, but I haven't interrogated that for sure. I'll skip this slide. This is Kensel. This is my classroom slide that I use all the time. Well, maybe I'll just show it to you. The top chart shows the old crop bases. You'll see they peaked out right here and then fell off about 15 cents. And this is their new crop bid. They fell down to about -95, but in recent weeks, it's increased by about 25 cents. So that's not inconsequential. And I'm sure that is spelling the potential effects of the end of the old crop as we look at this market, which I'll speak to in a moment. So people always ask me, how do you project this? And I have to give an answer. I don't like it. I'd rather just talk fast and not take questions, but it's a reasonable question. And what we promote, we have fancy forecasting procedures that Dr. Bullock speaks to, but for practical use and day-to-day use for non-academics, we do two things. One is we do seasonal indexes. We try to build our marketing strategies around the seasonal behavior of the basis. That is behavior that occurs every year. It repeats itself just about always, such as the seasonal behavior of the basis. Or alternatively, we use MACD. That's, Frayne spoke about that and applied it in his case, to the case of futures. It can be similarly applied with a click of a button to the basis behavior. And on the chart that Frayne talked about, barchart.com, as well as mydtn.com, which are both free, with a click of a button, you can generate the MACD. So it's pretty easily accessible. So let me just speak to each of these. This is MACD. Ironically, you'll love this. When I first started our trading room, I had a graduate student from Norway named Stefan. It was before any of this was built into anybody's protocols. So I had him create a spreadsheet. This was 2012-13. I had him create a spreadsheet that calculated moving averages and the MACD convergence divergence lines and the buy sell signal. It was a pretty elaborate spreadsheet. And then we used that in teaching. It was a pretty elaborate assignment. And of course, by 2017, DTN incorporated this in their standard DTN Profit X, and I know now Barchart has it as others. But what moving averages are trying to do is tell you that there's a turning point. So the basis is falling, it says, okay, we're at the bottom, now it's turning upwards. Where the basis is going up, okay, we're now at the top, we're gonna start moving downwards. So that's what moving averages do. So here's the most recent moving MACD applied to air. Now this is, I did this on Saturday instead of last week. But you'll see the air bases fell from about -60 to about -84 from seasonal highs in November to seasonal lows here in February. But since then, it's increased to -65. So that's a pretty big increase. That's a 20-cent increase in the basis. I know that we've changed that much in futures, but this is comparable to the change in futures. So the MACD on this says very clearly, this is a buy signal. It says the basis is now turning bullish. We were negative here. It really turned negative here on November 9th. And it was really negative for this entire duration until really right here, commencing with that period right there, just at the end of February, it turned very positively bullish. Okay, so when we do seasonal indexes, this is a pretty elaborate statistical procedure. Well, it's not so elaborate. We do it in a spreadsheet, but we calculate indexes, and this is on Jamestown, which we did a couple years ago. We do it on spreadsheets, and there's spreadsheet protocols or packages now that do this. But this derives a seasonal index. So what it does is takes a longer period of time and takes out any trend that's existing there or any randomness and derives what we may interpret it to be an index. And so you can see this red line is the index. So reading down here in September says on average, the basis will be 100% of the crop year average in September. And it will increase and reach a peak at 105% in December. So that means that on average, it will have a 5% increase in the basis from September until December. Then it falls down again and reaches another peak in February, and then it falls into the new crop period. So this directly coincides with harvest period United States, September, October, peak in November, at about the time when just before the rail secondary car market is peaked and farmers are selling, and then it begins to fall. And as we get into January, February, it starts falling pretty radically because of the anticipated new crop Brazilian harvest. So what that kind of says, if things haven't changed, is pretty much a no-brainer. Store at harvest, plan to sell in November. Hedge around it. So I've been for many years doing work on the seasonality thing. I always created a chart to find out when is the seasonal low and the seasonal high. And a couple of years ago, now Brock Associates came out with doing a chart similar to that. There's this nicer looking than mine, so I'll use theirs. But they went back in central Illinois and found the seasonal low from 1970 to 1617. And in central Illinois, that the month that had the greatest frequency of seasonal lows was October, followed by September, followed by August and September. And then beyond that, there's hardly no chance that beyond that will be seasonal lows in the basis. So that's a pretty significant side to support what we've been talking about. Okay, so now, what about looking in just the last couple of slides? What about looking forward to 2021? So probably there's two key factors. One is the speed and size of the Brazilian harvest. The second is the rate of China purchases. And in fact, in Dr. Bullock's work, China purchases were one of the most important factors impacting basis variability. So I keep track of this pretty carefully, and I share with you the following chart, and I'll talk about it. But so this goes from September going forward to December 21. And this shows the percentage of coverage in China. This shows their estimated total demand by month. On average, their total demand is about 8.4 million tons a month. That's about 100 million tons a year. And on this column here, it shows the amount of purchases they've made and loaded. Now, as Frayne talked about, that's not a very precise number, because whereas in the United States, we report loadings on a weekly basis and shipments on a weekly basis. Other countries don't always do that. Brazil is better than other countries, some other countries, but most other countries don't embrace the idea of needing to give new information in the market all the time. And furthermore, they might buy from the United States, but then they might sell it and then buy at another origin. And the traders come to call this nowadays called wash trades. So they'll buy from one origin, hold that position, and then wash the trade and shift the origin to another origin. It's a very brutal aspect of international competition. But having said that, this middle column shows how much they've purchased to date, and then how much they bought from the United States, and South America, Brazil, and Argentina, and then the US share. So demand is about 8.5 million tons a month. China is very well covered, very, very well covered, as you can see here, into probably April, okay? So they have very well covered in March, which means they'll carry that over into April and May. So they're very well covered into April, and I'm sure the Chinese buyers are thinking right now, prices have spiked, crushing margins in China have deteriorated substantially. They got a huge Brazilian crop going to be harvested late, and I'm guessing they're thinking that'll force the bases down, and then they'll accelerate the purchases from South America for that May position and May forward. And as you can see, they get into August and September, they have very little coverage. In September, they've only bought 1% or 0.1% of their needs. So what are they looking at? They know they're going to have the end of an old crop Brazilian to be buying from and the beginning of probably a record large US crop. So they're probably thinking that bases will crash and futures will fall. So that's pretty crucial. So, you know, I would not look for a lot of Chinese buying until we get closer into August, September, looking for that time slot there of August, September through November. So importantly, you'll see here that the US dominates the Chinese business in September through about January. And after that, in February, is kind of a tug of war between Brazil's new crop and the end of our old crop. And then as we get into August, it's also a tug of war between the end of Brazilian old crop and the beginning of US new crop. So that's the competitive battle. Okay, so my overriding slide and concluding slide is the following. The overriding factors this year impacting the basis, and probably this is true every year, is understand the seasonality is really critical this year. The stocks are negligible. I didn't use the number 0.03 because nobody knows how close we're going to be to zero. If we end up importing, does that mean we're at zero? Probably. The Brazilian pace of harvest, pace and size of harvest, timing of China purchases. The basis right now is about approximately normal, but slightly higher in the country. It's probably reflecting cheap secondary car market values, which will persist until we get into late October. We're in a futures market inverse, which has the effect of having downward pressure on the basis. The other one that I guess I didn't realize it until a few years ago, we started modeling this. There's a very important inverse correlation between bases and futures. And today, the correlation between futures and bases is minus 0.78 in Jamestown. The last 20 days, if you did a correlation on the basis and futures price, it's equal to minus 0.78. What does that mean? If futures prices go up $1, soybean basis is going to go down by some amount, probably about 50 cents. That's a big deal. And I kind of highlight that because I think I have every textbook that exists on this topic and nobody talks about this. At best, they would sort of say, well, we assume that there's no correlation between futures prices and basis values, but it's a very significant, in this case, inverse correlation. It's not static, but it's pretty important. So as we look at old crop and new crop, I would say the following. There's a slight chance of rally into July, but it's very risky. If you look at the basis charts I showed you for Jamestown and Air, yes, there are a couple years in the past 10 where we get a spike in the bases in July, but the likelihood of that happening is not very good. And I say that because the standard error or standard deviation, in my case there, is very, very wide. And I'm sure that's a balance between China managing their import purchases, the timing of their import purchases, the end of the Brazilian old crop shipping period, and the outlook for new crop supplies. Secondly, I think it's very, very important here. The Brazilian FOB basis today is negative. It's projected to go up to a plus 120. That's a $1.20 increase in the basis in the next 5 months. That will ultimately put upward pressure on basis values in North America. From US Gulf, as I recall, David's causation is firstly to the US Gulf, then the PNW, and then to the interior bases. The third point is the following. We have excessively tight end of crop year old stocks, and we have extremely strong demand for oil. So in recent days, you'll see more and more discussion about the tremendous amount of oil being used for refined oil to be used in biodiesel. You're going to be hearing about a plant in Western North Dakota paying $2,000 over futures to buy soybean oil. And all these other requirements are really driving soybean oil and therefore the demand for soybeans. And the presumption of the market is farmers are virtually sold out. So what that means is there's an idea that US domestic crushers are short relative to the demand for oil. And there was a projection over the weekend by a notable commodity analyst who said you could expect to see 100 over May for new crop bases in the Western United States. So 100 over, remember the chart I showed you in Kensel was 70 under. So if he says it's going to go to 100 over, that's a big swing in the basis. I'm not necessarily projecting that, but I want you to understand the very tender position we are in now in the basis as we balance this transition from old crop to new crop, compounded by China purchasing and compounded by the demand for soybean oil. Just remember, we got seasonal lows in August and September. I expect that will be the case this year because there will be a large crop. Farmers will be selling large, and the secondary market is seasonally low in August and September. Until we get to first half October, the basis typically peaks then in November and December, potentially in the first half January, depending upon the timing and outlook of the Brazilian harvest. So with that, I close, Jenna, and I'd be happy to take questions as you tee them up for me. So I'm reading.
I'm muted. You'd think by now I would realize that.
So I'll just read them to the audience, then I'll try to answer it.
Sure, sure.
Okay. In past years, we've seen substantial changes in crop bases due to crude oil transportation. Is this problem again due to policy changes permitting oil pipelines? So I don't know that answer, and I don't know if it will be. This was a problem in 2013-14, but there were many other things going on during that particular crop year. Most important was USDA, most railroads and commodity companies severely underestimated the size of the US crop. Looking forward, I think the suggestion might be that if they shut off the pipeline, it'll force more into rail, and that might take away from the grain business. I don't know if that would be the case this year. My guess would be the railroads have become a little better now at planning and anticipating their capacity needs.
And if I could add to that, Bill, we had a call with BNSF last week, and that question has been asked of them for a while now. And Angela with BNSF really covered the difference in infrastructure of the railroad between here and the PNW from the last time that was an issue to now. There's been more two-way railroad construction. there's just really a lot of added capacity and greater efficiencies that have happened since that point. So definitely not something BNSF is concerned about at this point. They think they will have capacity for all that they need.
In fact, they're more concerned about farmers selling.
Yeah.
Yeah. Okay, the second question, in terms of China-U.S. demand, how much will the phase one U.S.-China trade agreement play a factor? So I'm probably in the minority on this. I'm not so high on the phase one U.S.-China trade demand. As they went through the first year, they did not meet what they were supposed to be buying. They bought their brains out, but they still didn't achieve what they apparently had committed to. I don't really know the status of it now. I do know that they've underpurchased relative to it. And I'm sure the answer to this question is the approach that the Biden administration takes towards negotiating with China. On balance though, Scott, I tell you this, I think China buys in response to their supply and demand. And they have an extreme demand for all commodities now due to multiple factors. And they're buying as much as they can buy, whether it be corn, soybeans, or wheat. And that's what we're seeing now. And that's probably irrespective, in my view, of the phase one agreement.
All right, I see just one more in the chat here. Basically, Joe wants to know your predictions for new crop basis. He said last year he sold at harvest and it worked well for him with the inverted market. And do you expect that to be a good plan coming into this year with new crop as well?
So I would take the view of the following. I suspect August and September, the bases will be under pressure to crash. And it will be driven in part by the very large crop in the United States that's going to be harvested. Large crop, farmers will start selling cash extensively, which will force, in part to clear space, in part to capture the higher prices, but that'll force the bases down. And then it'll escalate, and I suspect escalate rapidly and look for peaking in November. So this year, like most of the previous years, we'll see, I would view, or plan on a slightly depressed basis at harvest with a sharp increase into November-ish. That's what I would look for.
Yeah, we kind of have a similar question in the Q&A function here, whether it's a better strategy to lock in cash contract for fall delivery versus an HTA.
Yeah, I'm, so you got me stumped here. So it seems to me you got to be taking some coverage in the futures market, whether that's by a direct hedge or an HTA. An HTA is preferred. It's a perfect grower contract. The only problem with it, it ties you to that particular elevator, but nevertheless, you got the futures component of this locked in. What I would look for is locking, okay, to answer your question, I'd lock in some of your crop with an HTA to capture the current futures values for a portion of your crop, looking to sell it into the November-ish period when the bases would be stronger. That'd be my answer.
Any other questions for Dr. Wilson? I know you had kind of a hard stop at 11:15 and we're pretty much there.
Now, on these questions you asked, I mean, I'm giving you my views. I just want everyone to understand, we're in uncharted territories. There's only a couple of times in the past 20 years we've been at this futures level. There's only a couple of times we've been at these types of basis positions in this big of an inverse. So it's hard to infer exactly. So we're giving you a projection the way I see it. But tomorrow when Frayne's on, I see he's not on now, but you can ask him these questions as well. But it seems to me from a risk management perspective, you got to be looking to lock in a significant amount of your coverage somehow.
Well, I don't see any more questions in either the Q&A or the chat. So,
And then I'll be on again tomorrow if they want to follow up
okay.
with questions.
Okay, wonderful. Yes, that's a good segue into tomorrow morning. We'll be back at this again 8 to 11, 11:30-ish, seeing how long we go. So tomorrow we have Dr. David Bullock, Dr. Frayne Olson, and we also have an industry perspective. Sean Holm from the Gavilon Group will be speaking into his perspective as well. So with that, I want to thank everyone that's been on this morning. If you have questions, remember you can ask them tomorrow. You can email me overnight tonight. But I thank you for being here, and I hope we see you tomorrow morning.